evening,
sir.
sir.
Evening, sir.
Yes, good evening. Okay, how's your preparations going on? Good?
Yes, sir. Yes, sir.
Yes, okay. Shall we start?
Yes, sir.
Yes, sir.
Fine. So, today's session, we will be focusing on the three chapters that we have discussed in FM. What are the three chapters? Investment decision, which is nothing but capital budgeting. Then risk analysis in capital budgeting. And lastly, dividend decisions. These are the three chapters that we'll be focusing. Investment decision, capital budgeting is very, very important chapter. Normally more questions will be asked from that, and it's a very simple chapter. Basically, we need to understand the logic behind the concepts, right? Then it will be easy for us to understand. Okay, so we'll start straight away with that chapter itself. Investment decisions or capital budgeting. Basically, what's the objective of this discussion? The objective of this discussion is to identify the optimum way of utilization of funds. Why? In financial management, any question regarding why we have to do that is to maximize the wealth of the shareholders. That's the focus in FM, right? So normally in FM, theory questions also will be asked. So we have to be aware of the concepts as well. So when they say why capital budgeting, the first point that we have to write is maximize the wealth of shareholders. Maximize the shareholders' wealth. So capital budgeting, investment decision is also called as capital budgeting. Why? Because here we are budgeting the capital investment. Budgeting the capital investment. So in working capital management, you would have learned cash budget or budget of working capital. There we are focusing on short-term finance, focusing on budgeting the expenses that we will incur in the next 1 year, etc. But here we are looking at long-term investments. We are looking at long-term investments, investment in a project, investment in a machinery. So since it is long-term, huge money is involved and its impact would be there for many number of years, capital budgeting becomes very, very important. So what is there in this? What's there in this capital budgeting? First, what we will do is we will plan and identify various opportunities. Identify various opportunities, evaluate each of the opportunity, then select the best possible opportunity based on the benefit that we are receiving from any of such opportunities, right? Once you select, it doesn't stop there. Once a decision is made, doesn't stop there. It also goes for implementation. Implementation of that decision is also important. Post implementation, again, controlling after implementation, then reviewing whether it is going as per plan and taking corrective actions, right? So that's what is involved. So identification of investment project that are strategic to business's overall objectives, estimating and evaluating post-tax incremental cash flow for each of the proposals. So which is having the highest cash flow, we will go with that. Selection of investment proposal that maximizes the returns to investor, right? What are the purposes of capital budgeting? Why do we need capital budgeting? Because of substantial expenditure. That's the first point. Huge amount of expenditure is involved. In case of working capital, day-to-day expenditure, the amount involved is lesser than this, right? When we look at investment in a project, it will be big amounts. Since big amounts are involved, substantial expenditure is involved, capital budgeting is very much required. And as I said, it is for long term. The decisions what we take will have a long-term impact. And once we make a decision, once we invest in a particular project, once we purchase a machinery, that decision is irreversible, right? That decision is irreversible. It cannot be reversed back. And complexity in the decisions because of these four reasons. So why capital budgeting? Substantial expenditure is involved, long time period, and irreversible decisions, as well as the decision making is complex. Decision making is complex. These are the four reasons or four purposes why we have capital budgeting. Capital budgeting process, we have planning, identification of investment opportunity. If merits are promising, then we go to the next phase. If merits are not so positive, in the sense merits are very little, then we reject that opportunity. In the evaluation stage, all those investment opportunities would be evaluated. Their inflows and outflows would be considered. And based on that analysis, evaluation, you will consider that particular project which maximizes the shareholders' wealth. Then implementation, you will arrange for necessary funds, purchase of assets, then implement it. Control, progress of the project is monitored. Then review the project to explain its success or failure. Right? So capital investment, when we look at capital investment, there are various types of capital investment decisions that we can make. First one is replacement decision and modernization decision. What is this replacement and modernization? Replacement decision would happen in case of those assets where their life of the asset is over. Life of the asset is over, we are replacing such asset. Replacement decision. Modernization decision is whenever there is technological upgradation, and the present machinery or present appliances are not it's not possible for that particular machinery to upgrade to the present technology. In such cases, modernization decisions come into picture, right? Replacement and modernization. Then expansion decision is during the growth stage. Whenever the firm is growing, when the existing capacity is not sufficient, we go for expansion decision. Diversification, when we enter into various opportunities, right? When we various fields, business fields, to have control over various fields, we may diversify our focus, right? So diversification decisions. So these are the three major decisions in case of based on firm's existence. Here, replacement and modernization decision, both put together, is called cost reduction decision. Why cost reduction decision? Because in that, we focus on that particular aspect, that particular machinery, which will help us to reduce the cost. Replacement and modernization decision aims to improve the operational efficiency and reduce the cost. Plant and machinery require replacement due to economic life is over, replacement decision, or becomes technically outdated, modernization decisions. So both put together are called cost reduction decision. Expansion is during growth stage, and diversification, diversify into new product lines. This is based on firm's existence. Based on situations, we can divide it into three different aspects. Mutually exclusive decisions. That means when we have two decisions, if we choose one, the other cannot occur. We call them mutually exclusive, right? So mutually exclusive decisions. Accept, reject decisions. These are independent proposals which are not dependent on each other. Contingent decisions are dependent proposals. Whenever we have dependent proposals, accepting one proposal depends upon what happens in the other proposal, then that is called contingent decisions. If those two proposals under review are independent of each other, we go with accept, reject decision. Accepting one will not impact the other one. Then it is accept, reject decisions, right? So mutually exclusive, if two or more alternative proposals are such that acceptance of one proposal will exclude the acceptance of the other proposal. Installation of semi-automatic or highly automatic machine. So if semi-automatic is installed, you cannot purchase highly automatic. Highly automatic is installed, then semi-automatic is not under consideration, correct? They are mutually exclusive. Whereas accept, reject decisions occurs when proposals are independent and do not compete with each other. Then it will be based on minimum return on investment required. Contingent decisions are made when proposals are dependable proposals. Investment in one proposal requires investment in one or more other proposals. If a company accepts a proposal to set up a factory in remote area, it will also have to invest in infrastructure there, right? So because nothing will be there. So from scratch, they have to invest. So it is contingent decision. Are we understanding?
Yes, sir.
Yes, sir.
Yes, that's the first part. Then what do we do in capital budgeting? First, we will estimate all the cash flows over the entire life of the project. By purchasing the machinery, what would be the cash flow over the life of the project? That is what we first estimate. Once we estimate that, we will evaluate each of the alternatives available. So if there are two machineries, then in both the cases, we would have that estimation of cash flows. Evaluate, compare. Determine the minimum required rate of return, discount rate. Why do we have discount rate here? To calculate present value. Correct? To calculate present value. So we calculate present value. Then how do we estimate the cash flows? How do we estimate the cash flows? To understand that, normally we go with incremental cash flows from an investment. Right? Normally we go with incremental cash flows. We will not go with accounting profits. We are going with cash flows, not profits. Why? Because in case of accounting profits, these are the limitations. Can be asked in the exam. Right? Limitations of accounting profits. Timing of the cash flow may not match with the period of profit. So cash flow, where whatever we are receiving and the profit period recognized might be different. Simple example, sales invoice would have been raised in March. That means it would be included in the financials of 22-23 because March 23 comes under 22-23 and sales would have been recorded in that month. But if we receive it in April, receipt happens in a different period. Profit is of this period. Receipt is happening in this period. So when I consider cash flows, it will be cash flow of April. Correct? It will be a cash flow of April. So timing of cash flow will normally not match with the period of profit. And accounting profit includes non-cash items like depreciation, etc., which is not relevant for us in decision making. Then cash flows are estimated based on input provided by various departments. So we go with hands-on data, right? From individual department, we'll ask what is the sales that you're expected to make, what are the expenses that you have, what are the purchases that you make during the period. So individual department, relevant department, we ask and get the data in case of cash flow. Therefore, cash flows are more relevant or more preferable in case of capital budgeting decisions. Capital budgeting goes with cash flows. When I say cash flows, there are two types: cash outflow, cash inflow. Correct? Cash outflow normally happens at the initial stage. There might be some incremental or additional investment required during the life. Cash inflow will happen throughout the life of the project. Throughout the life of the project. Right? So calculating cash flows, there are certain aspects. Depreciation as such will not be a cash flow. However, because of depreciation expenditure, tax payment will be lesser. Because depreciation is an allowable expenditure, hence tax component on depreciation will be treated as cash inflow. Because it reduced my tax, it reduces my cash outflow, hence it is treated as cash inflow. Tax benefit on depreciation is considered as cash inflow. Are we clear? Yes. Then yes, opportunity cost. Opportunity cost is the cost that we are foregoing, the benefit that we are foregoing by not investing in that alternate investment option. Correct? So opportunity cost is considered for the purpose of estimating cash outflow. It will be considered as cash outflow. Sunk cost. Sunk cost means it's already incurred, historical. It is not relevant for us for future decision. Correct? Sunk cost will not be considered for capital budgeting analysis. It will be excluded from capital budgeting analysis. Sunk cost. Working capital. Now, working capital requirement can be considered in different ways. One is initial working capital. At the time, starting stage, initial working capital is considered as cash outflow. Right? Initially, whatever working capital that we will invest in the business. Then, over the life, we might require additional working capital. It will also be considered as cash outflow. It will also be considered as cash outflow. Then you have reduction in working capital. Reduction in working capital will be considered as
cash inflow.
Cash inflow.
Cash inflow, correct. Cash inflow, because increase in working capital, cash outflow, reduction in working capital should be cash inflow, correct. And at the end of the project, release of working capital, whatever you have invested, that will also be cash inflow. Release of working capital shall also be cash inflow. Is that clear?
Yes, sir.
Yes.
Yes. Then there would be overheads allocated. Overheads allocated. Allocation of overheads. Expenditure is already incurred. After the expenditure is incurred, this expenditure would be allocated to different departments. So allocated overheads will not be considered as cash flow. Should not be considered for cash flow because expenditures would have already been incurred earlier. Only that expenditure is allocated to the various departments here. Therefore, it is not considered as cash flow. Additional capital investment obviously is cash outflow. cash outflow. Okay, write down. While determining the cash flow, below that, first point, depreciation. Below that, depreciation as such should not be considered. Depreciation as such should not be considered, as it is non-cash. As it is non-cash. Full stop. However, the tax benefit on such depreciation, shall be considered as
Cash inflow.
cash inflow. Correct. Shall be considered as cash inflow. Point number two, opportunity cost. Opportunity cost shall be
Cash outflow.
cash outflow. Correct. Opportunity cost, cash outflow. Point number three, sunk cost.
No cost.
Shall not be considered for cash flow. Then point number four, working capital. Below that, initial working capital, cash outflow, additional working capital, cash outflow, reduction in working capital. Yes, reduction in working capital, cash inflow. And lastly, release of working capital at the end. Cash inflow. Yes, cash inflow. Next point number 5. Allocated overheads. What happens?
Shall not be considered.
Yes, shall not be considered for cash flows. Allocated overheads shall not be considered for cash flows. Next, last point, additional capital investment. Cash outflow. Additional capital investment, cash outflow. Yes. Right. Okay. Now, any cash flow when we are analyzing, say at the end of the day in capital budgeting, we go with cash flows. Whatever cash outflow which is happening, cash inflow that we are getting. Correct. So cash flows can be divided into 3 different categories. One is initial cash flow. Normally, initial cash flow will be outflow. Right? It will only be outflow, whatever we are investing. Then you have interim cash flows. Interim cash flows normally will be inflow. There will be some outflows also, like additional working capital. Then you will have additional capital investment that can happen, correct? So there would be interim cash flows as well, but normally cash inflows. Then at the end, terminal cash flow, normally it will be terminal cash inflow only by selling the machinery, scrap value of that machinery, correct? So these are the 3 different categories of cash flows. So we have to analyze how do we calculate these cash flows individually. First, initial cash flow. How do we analyze? How do we get this cash flow? Initial cash flow will be what? Cash outflow. So whatever you are investing, whatever amount that you are spending for purchasing that asset. So normally initial cash flows can be divided into fresh proposal or new decisions or a replacement decision. This is you are investing in that machinery for the first time. In replacement decision, that machinery's life is over. So you are replacing that machinery with the old one. What would be the difference? In case of replacement decision, you will also have sale value of the old machinery. Correct? Sale value of the old machinery. Whereas in fresh decision, whatever you are purchasing would be your outflow. There will be no inflow at the time of purchase. Correct? So cost of the new asset, whatever installation cost, setup cost, etc. And to run that machinery, whatever working capital is required, that working capital will give you the total initial cash flow. So basically, whatever amount is required at the time of purchase of machinery, that is initial cash outflow. Purchase cost, setup cost, and working capital requirement. Same thing will be there in replacement decision also. Cost of the new asset, installation or setup cost. But instead of full working capital, whatever increase or decrease in working capital that is required, because already working capital is there because you had a machinery already. So working capital is already in place. Whatever increment you have, increase or decrease, there might be decrease in working capital also, increase in working capital also. If it is increase in working capital, extra money, so add. If it is a decrease in working capital, then today's outflow will be lesser, so subtract. Then that old machinery would be sold. So net proceeds of that old machinery. So because of that sale, there might be tax impact. Because of sale of old machinery, what would be the tax impact? You would have claimed depreciation. So that block of the asset, in case of block of the asset, if there is no block is not existing, once the asset is sold, then short-term capital gain or short-term capital loss come into picture. If block exists, depreciation will continue. Correct? That's what is there. So the tax impact, if any, if it is an expenditure, outflow, add it. If it is a savings, subtract. Subtract it from the requirement. So this gives you the initial cash flow in case of replacement decision. So in case of normally, what you have to focus on in cash outflow, purchase cost, installation cost, working capital. But in case of replacement decision, additionally, you will have sale value of asset, old asset, and tax impact on that. Right? Additionally, two items come into picture in case of replacement decisions. Are we understanding?
Yes, sir.
Yes, sir. This is for initial cash outflow. Whereas during the period, interim cash flows, it depends upon whether, again, it's a new project or a replacement decision. If it is a new project, then over the life of the project, you will have what is the cash inflow that you get? Profit, add non-cash expenditure. We had discussed this. Cash flow after tax. How do you get cash flow after tax? Profit after tax, add depreciation. Profit after tax, add depreciation. That gives you the operating cash flows. Correct? Operating cash flows. To that, any change in the working capital. If it is decrease in the working capital, add. Reduction in working capital. If it is increase in working capital, subtract from the cash inflows. That gives you interim net cash flow for the period. Interim net cash flow for the period. Whereas in case of replacement decision, you have to go with comparison. Because of that asset being replaced, what is the increase or decrease in the profit, operating revenue? Increase or decrease in the operating expense? Net change in income before tax? Increase or decrease or increase in the tax? Net change in income after tax? Add back net change in depreciation, you get incremental net cash flow for the period. So we are going with incremental cash flow in case of replacement decision. Because of the new machinery, what is the incremental cash inflow or incremental cash outflow? Right? That is in case of interim. Then at the end, terminal cash flows. Terminal cash flow, what happens? You will be selling the machinery. So salvage value of the machinery sold. Add interim cash flow of that year. If there is any profit out inflow that you have earned, add it to that. Then because of your selling this asset, tax savings or tax expense adjustment should be made. Then since the project is coming to an end, working capital will be released. That release of net working capital should be added. This gives you terminal year incremental net cash flow. Terminal year incremental net cash flow. So we'll quickly summarize what we have learned with regard to cash flows. We have divided the cash flows into 3 different categories. First one is initial cash flow, normally outflow. Second one is interim cash flows, normally inflow. Third one is terminal cash flows, again normally inflow by selling the assets, correct? So initial cash flows again depends upon whether it is expansion decision or new project or replacement decision, correct? If it is a new project, we are just focusing on cost of the asset. You will add installation charges, you will add working capital requirement. Whereas in case of replacement, yes, you will consider cost of the asset, you have to consider installation, but instead of full working capital, we'll only go with increase or decrease in the working capital. Increase or decrease in working capital. Correct? Additionally, you will also have what?
Tax and
Sale proceeds. Correct? First, sale proceeds of old asset. Then increase or decrease, we do not know, of tax. Tax impact on old asset sale. Tax impact on old asset sale. This gives you initial cash outflow. Why initial cash outflow is required? That is the cost of the project. That's the cost of the project, correct? Present value of cash outflow. Then coming to interim cash flows, we are focusing on whatever incomes that we are receiving, cash flows that we are receiving. So again, we have to divide it into two different categories. In case of new project, we go with full values. That is, we will calculate cash flow after tax. How do I calculate cash flow after tax? Profit after tax plus depreciation. Right? Cash flow after tax. To that cash flow after tax, add or subtract working capital change. If there is decrease in working capital, I have to add, because decrease in working capital means cash inflow. If there is increase in working capital, subtract. Accordingly, you will get interim cash flow. Okay. Whereas if it is replacement decision, what happens? In case of replacement decisions, we have to go with increment. So we will consider incremental cash flow after tax. How do I get incremental cash flow? Compare it with existing. What is the increase or decrease that is happening? That is in case of interim. Whereas in case of terminal cash flows, we are not bothered about whether it is new project or replacement decision, because ultimately we are selling the asset, irrespective of whether it was a new project or replacement, correct? So we will consider sale value of such asset to that current year cash inflow, operating cash inflows. Then adjust the tax impact on sale. And add the release of working capital. Last end, right? Release of working capital should be added. This gives you terminal cash inflow. So this is how we will be estimating the cash inflows. Are we clear?
Yes, sir.
Yes, sir.
Yes. So I was talking about the tax savings, right? Tax savings, again, you would have learned that in income tax. Just to brief about tax savings depends on whether block exists or not. Block of assets, when asset is sold, where a block does not exist. That means no other asset is there in the block. Where block does not exist, in that case, tax benefit, that means what do we understand by tax benefit? That means you still have WDV. In that case, it will be treated as short-term capital loss. If you have sold it at a higher price than WDV, it will be considered as sale value greater than WDV, then short-term capital gain. Correct? Short-term capital gain. Whereas assets exist in the block, even though this asset is sold, other assets exist. In that case, what do we do? In case of deletion of asset, we will reduce the sale proceeds from the WDV and calculate depreciation on the balance. Correct? Calculate depreciation. calculate depreciation. Is that clear? Yes. So that is how. So tax savings come into picture only in this case, in such scenarios, right? Yes. And whenever you are analyzing the cash flows, financial charge like interest on long-term debt and dividends, equity dividends, etc., shall not be considered. These two will not be part of our the capital cash flows. These two cannot be considered as cash flows. Therefore, when we are adding up interest, we say PAT plus interest into 1 minus tax rate, because interest is tax deductible expenditure. So interest into 1 minus tax rate to be considered. This concept is called post-tax principle. This concept is called post-tax principle, PAT plus interest into 1 minus tax rate. Is that clear? Yes. So how do you calculate cash flow after tax? Cash flow after tax is PAT plus depreciation. PAT plus depreciation. So that is what we have to keep in mind. Whenever net present value or profitability index, any calculation is asked, we are going with cash flow after tax, not profit after tax. How do you get cash flow after tax? PAT plus depreciation. Yes. So we have various capital budgeting techniques, right, to evaluate the decision making. Various capital budgeting techniques. So this was block of assets. We have already discussed this. Okay, if required, we have an example here. We'll look into this. Treatment of depreciation. See, purchase price of the machinery. Depreciation at 20% for year 1. WDV 20% for year 2. WDV year 2, year 4. So WDV at the end of year 4 is 40,960. Now, if the asset is sold at 10,000 rupees, if the block does not exist, then 30,960 is the short-term capital loss. WDV still exists, right? 30,960 is short-term capital loss, but I cannot say 30,960 as tax savings. Why? Because tax benefit is only the applicable rate, which is 30%, presuming. If 30% is the applicable tax rate, then 30,960 into 30%, 9288 is the tax savings, which has to be added or subtracted.
Subtracted from the cost.
Subtracted from the cash outflow. Correct. See, in initial cash outflow discussion, what are we focusing on? We are focusing on the cost of the investment. When we are focusing on cost of the investment, tax savings should be subtracted. Whereas in case of terminal cash flows, we are focusing on cash inflow. There, this tax benefit should be added. Tax benefit should be added. So it depends upon the scenario. So tax benefit should be added in case of terminal cash inflow, reduced in case of initial cash outflow. Reverse the case in case of tax cost, tax loss, right? That is the reverse. Yes. However, if the cost block exists, 40,960 minus that sale proceeds 10,000, 30,960 would be WDV. On that, depreciation will be calculated 6192. Tax benefit on depreciation will be 185. Normal, 30% on the depreciation amount. However, if sale value of the machinery was 50,000 instead of 10,000, then in the first case, 40,960 minus 50,000, you get 9040 positive, which is short-term capital gain. Now, this is a tax loss, 2712, added in case of initial cash outflow, reduced in case of terminal cash. Reduced in case of terminal cash outflow. Are we understanding?
Yes, sir.
Yes, sir.
Yes, sir.
Okay. Tax impact. Right on. Tax impact. Tax impact. Below that, two arrow marks. Tax benefit. Right hand side. Tax loss. Tax benefit, tax loss. Below tax benefit, reduced in case of initial cash inflow, added in case of terminal cash.
Initial cash outflow, right?
Correct. Reduced in case of initial cash outflow. added in case of terminal cash inflow. Added in case of terminal cash inflow. Added in case of terminal cash inflow. Right hand side, tax loss. Added in case of initial cash outflow. Added in case of initial cash outflow. Reduced in case of
terminal.
yes, reduced in case of terminal cash inflow. Are we clear with this?
Yes, sir.
Yes, sir.
Yes. Yes, exclusion of financing cost principle. When cash flow relating to long-term funds are defined, financing cost of long-term funds should be excluded because interest and dividend payment are reflected in WACC, correct? Weighted average cost of capital. Normally, discount rate is WACC, weighted average cost of capital. Weighted average cost of capital includes long-term debt. Long-term debt. Therefore, long-term interest debt on interest on long-term debt should not be considered for cash flows. Okay. Then post-tax principle we have considered. So how do you calculate cash flow after tax? Same, or you consider everything, earnings after tax, add depreciation. Then coming to capital budgeting techniques. Capital budgeting techniques, we have 7 techniques in our syllabus. Traditional or non-discounting techniques and discounted cash flow techniques. Under traditional or non-discounting, we have payback period and accounting rate of return. What is payback period? Payback period is the time period that is required to recover the investment. Accounting rate of return is the return in percentage. What is the return I'm getting on the investment? Book profit, accounting profit. Right? In accounting rate of return, accounting profit is considered. Whereas discounted cash flows, we have NPV, profitability index, IRR, discounted PVP, and MIRR, modified internal rate of return. So in this payback period, it's the time required to recover the initial cash flows. How do you calculate payback period? That depends upon whether cash flow is uniform or not. Cash flow is uniform or not. In case of uniform cash flows, that means every year I'm getting 1 lakh rupees. Correct. Every year I'm getting 1 lakh rupees. Initial investment was 3 years. Then initial investment divided by annual cash inflow will give you the payback period. 3 lakh divided by 1 lakh, 3 years. Correct? Yes. So in case of uniform cash flows, initial cash investment divided by annual cash flows. Annual cash inflow. Initial cash investment divided by annual cash inflow will give you payback period. However, normally cash inflows will not be uniform. In case of non-uniform cases, we use the concept of cumulative cash flow. Cumulative cash flow. That means initial investment is 3 lakh. First year I have got 1 lakh rupees. Second year I have got 80,000 rupees. Third year I got 60,000 rupees. Fourth year I got 1.5 lakh rupees. And fifth year I got 2 lakh rupees. In this case, I go with cumulative. 1 lakh, 1.8 lakh, 2.4 lakh, 3.9 lakh, and 5.9 lakh. Cumulative. Correct? Adding up. Once we do that, identify the year in which this 3 lakh is crossed. It's crossed in the 4th year. After 3rd year. Correct? Before the end of 4th year. So then what do we do? Compute the fraction by interpolation formula. Correct? So we go with cumulative cash inflow. Then we have to go with corresponding period when total of cumulative cash inflow is equal to cash outflow. If exactly I got 3 lakh here, then that would be the payback period. If I do not get 3 lakh, if I get more or less, then I have to go with the finding out that fraction years. Correct? Yes, that's how we will calculate payback period. So in case of uniform cash flows, that's simple. Total cash investment divided by annual expected after tax net cash inflow. Non-uniform, cumulative cash inflow from operation must be calculated. Payback period shall be corresponding period when the total of cumulative cash inflows is equal to initial capital investment. If the exact sum does not match, then the period in which it lies should be identified. Then compute the fraction. Advantage. What are the advantages of payback period? it's easy to calculate. Very easy to calculate, right? Easy to understand as it provides quick estimate of the time, and length of the payback period can serve as a estimate of project risk. Longer the payback period, risk is higher. Correct? So it helps us in estimating the risk advantages of payback period. These are the three: easy to compute, easy to understand, higher. This helps us in analyzing the risk of the project. Whereas limitation, in all traditional methods, first limitation that we have to write is ignore time value of money. Ignore time value of money. Then it will not consider cash flows after the payback period. It will only consider the cash flow up to payback period. After that, whether the cash flows reduced or increased, doesn't bother. Right? So that's the limitation. Second, I have a small project, I have a big project. Small project payback period is lesser when compared to the big project. If I only rely upon payback period, I'll go with the smaller project. Right? So places emphasis on shorter payback periods, thereby ignoring long-term projects. That's the limitation of payback period. Now, when I say payback period, you will get the time period. You will not get the returns in percentage, etc. Correct? So to get that, we have payback reciprocal. Ulta. In payback period, we have investment divided by cash flows. Here you will have cash flow divided by investment. So that you will get the percentage. Normally, payback reciprocal will be nearer to IRR, internal rate of return. Okay, payback reciprocal. A major drawback of payback period method of capital budgeting is that it does not indicate any cutoff period for the purpose of investment decision. Reciprocal of the payback would be a close approximation of IRR. If the life of the project is at least twice the payback period and project generates an equal amount of annual cash inflow. So payback reciprocal helps us to get the rate of return of the project. Annual cash inflow divided by initial investment will give you payback reciprocal. This is about payback period. Any doubts still here? Everyone following?
Yes, sir.
Yes. The next one is accounting rate of return, ARR. Right? So accounting rate of return is simple. Profit, average net income divided by investment. Profit divided by investment. So return on investment, basically accounting rate of return is. So average annual net income divided by investment. This investment can be initial investment or average investment, depending on the requirement. Right? There are three different types of ARR that we can calculate. Right? Three different types of ARR. What are those three? Annual basis, total investment basis, average investment basis. In annual basis, what do we consider? Profits of the year divided by investment at the beginning of the year into 100. Annual basis. Whereas total investment basis, we go with average profits, average annual profits. Here we were going with average profit of that year. Here, average annual profits divided by investment in the beginning into 100. Whereas average investment basis, same, average annual profits divided by average investment into 100. Instead of any investment in the beginning, we go with average investment. So that is the difference between these three. In case of annual basis, it is profit for the year. Profit for the year divided by investment at the beginning. Investment at the beginning. In case of total investment basis, it is average profits divided by investment at
Beginning.
beginning. Correct. Investment at beginning. Here denominator remains the same. Numerator changes. From profit for the year, it changes to average profit. Whereas in case of average investment basis, here now numerator remains the same. Average profits, denominator changes, average investment. Are we clear with this?
Yes, sir. Yes, sir.
Yes. What is this average investment? Average investment is not investment at the beginning plus investment at the end divided by 2. No. Average investment is initial investment minus salvage value divided by 2. This is same average. But to this, we will add back salvage value and add additional working capital. This is average investment. Right? Initial investment minus salvage value by 2. This is normal. That is investment at the beginning minus investment at the end divided by 2. To that, we will add salvage value we will add additional working capital. That is average investment. That is average investment. So average investment is equal to half into initial investment minus salvage value plus additional working capital. That's how accounting rate of return is calculated. So we have to understand first what is the requirement, whether it's annual, total or average. Average investment can be followed only if this required information is given. Now, if the required information is given and they are not specifically given which method to be followed, we have to go with average investment basis. If required investment information is not given, then total investment basis. If they have not given average annual profits, only this year profit, then we go with annual basis. Then we go with annual basis for the purpose of calculating ARR. What would be the advantage? Here, this is not cash flows. We are considering book profit. So information of net profit is readily available. Right? Uses readily available data that is routinely generated from financial reports. And second one, we are going with rate of return on investment. So it evaluates the operating performance of the entity. Right? Used to evaluate performance on the operating results of an investment. Then it uses the same procedure in both decision making and performance evaluation, ensures consistency. See, financial statement analysis and ARR goes hand in hand. So it provides consistency in evaluating or decision making. Then it considers all the income over the entire life, unlike payback period. In payback period, we are only focusing on cash flows up to that payback period. Beyond that, we are not focusing. Whereas here, we'll consider cash flows or incomes of all the years over the entire life of the project and provides a measure of investment's profitability. Whereas disadvantage, first point is same, time value of money. And the second point, here we are focusing on accounting numbers. When I say accounting profit, it is dependent on the accounting policy of the entity. Depreciation, dependent on the policy of the entity. It can be WDV or SLM. It might change. Correct? So, dependent on the accounting procedures, different accounting procedures used, depreciation methods can lead to substantial different amount of investment. So, the ARR can change. ARR can change depending on the different accounting policies used. Then, here we use net income rather than cash flows. Normally, for investment decisions, what have we discussed? Cash flows is a better measure of for the purpose of evaluation. And inclusion of only book value of the invested asset. That means we are only focusing on the book value of the asset. We are ignoring the incremental working capital. We are only focusing on P&L. But we have to also focus on balance sheet, the incremental working capital that is there. So that is ignored here. Working capital requirement is ignored. These are the limitations of ARR. Okay, limitations, advantages and limitations can be important of any method. Okay, any method, advantage. Sometimes it has been asked in the exams, so that becomes important. So these are the two traditional methods. Coming to discounting cash flow, the disadvantage of the traditional methods, that is time value of money, is overcome by calculating present value. How do we calculate present value? Using discount rates. Discounting is the concept. Right? First method in this is net present value. Very important method. Most of the time questions will be focused on this NPV calculation. Most of the times it will be NPV. Even in the next chapter that we discuss, it is again linked to NPV. So NPV is very, very important. It's very easy. Calculation of NPV. Ultimately, what you want present value of cash inflows and present value of cash outflow. If there is only initial cash outflow, that initial cash outflow itself will be the present value of cash outflow. However, if you have cash outflows during the life, that has to be discounted. That has to be discounted to get the present value, correct? Present value of cash inflows, first you will determine the cash inflow. If it is straight away given, you will consider it. If it is not given, if they have given profit after tax, then you have to compute profit after tax plus depreciation. If they are starting with sales, then you have to start from sales minus expenditure, including depreciation, then you'll get profit before tax, profit after tax, add back depreciation, cash flow after tax. So ultimately, you have to consider CFAT, cash flow after tax. On that, based on the discount rate given, you will calculate present value. That everyone knows. Correct? Then present value of cash outflow will be reduced to get NPV. So what are the steps involved? First, you determine the net cash inflow, compute the net cash inflow. If directly given, fair enough. Else, we have to calculate. Then you have to identify, Harshita, the tax rate or the discount rate rather. Identify or select the discount rate. Discount rate normally will be given in the exam, in the question. You need not worry about that, correct? Then using the discount rate, we have to calculate the present value factor. Present value factor. How do you calculate present value factor? If the discount rate is 8%, for the first year, it will be 1 divided by 1.08. For the second year, 1 divided by 1.08 square. For the third year, 1 divided by 1.08 cube, correct? That's how we get it, right? Discount factors. So then multiply the discount factor with the cash flow to get that year's discounted cash flow. Then add up everything. This is present value of cash inflow. Present value of cash inflow. One point that we have to keep in mind is last year you will have cash inflow of that year as well as salvage value. In that case, we should not consider either. If you're getting confused, you can add them together. Or if you're showing it as two different line items, ensure that you're not again discounting further one more year of discount factor. No, for both the discount factor will be the same because same year. Correct? So that mistake we should not do. That is one point that we have to keep in mind. Once you have present value of cash inflow, present value of cash outflow, NPV, how do you make the decision? If NPV is positive, you have to accept. NPV is negative, reject the proposal. Correct? That's how NPV is calculated. Any doubts in this? No. Okay, fine. So that's how NPV is calculated. Steps we have already discussed. What are the advantages of NPV? NPV, same, whatever was the disadvantage there, here becomes advantage, time value of money. Right? Am I audible?
Yes, sir.
Yes,
Sir.
Yes. Okay. So NPV considers time value of money. Here again, all cash flows are considered. The whole stream of cash flows are considered. NPV can be seen as addition to the wealth of the shareholders. How? Now, considering the discount rate also, if the NPV is positive, that means that it is really adding value to the shareholders. So, NPV can be considered as addition to the wealth of the shareholders. NPV uses discounted cash, which enables comparison of different projects. Now, project 1 has 5 years, project 2 has 7 years. Since we are going with discounted cash flows, comparison can be made. Comparison can be made. Whereas, what are the limitations? Calculation is difficult. If the time project life is 5 years, 4 years, okay, reasonable. If it is 10 years, 15 years, 20 years, calculating present value is difficult. Then accuracy of the NPV depends upon the forecasting cash flows. Cash flows at the end of the day are not audible.
Audible, sir.
There is a lag between your voice and video.
Okay, fine. Just give me a second. It's fine right now?
Yes, sir.
Okay.
yes, sir.
Okay, fine. See, it involves difficult calculations, whereas accuracy of NPV depends on forecasting your cash inflows. Right? Ultimately, cash inflows are of future years. Sorry, you're estimating it. So, whatever estimation you have done, if it is accurate, only then NPV will be accurate. Same way, discount rate. Discount rate is subjective. So, the accuracy at which you are identifying the discount rate also have an impact on the accuracy of NPV. And at the end of the day, NPV is an absolute measure. It's not in percentage, it's in figures. So, if a project, if it's a small project with an NPV of 20,000, investment is only 1 lakh. A large project, investment of 10 lakh, NPV of 30,000, we might go with the second project by just looking into NPV decisions, correct? But that might not be correct because for 1 lakh, I'm getting 20,000. For 10 lakhs, I'm getting only 30,000. So that is one limitation of NPV. It is only based on absolute measures. It ignores differential in initial cash outflow, size of different proposals while evaluating mutually exclusive projects. That's about NPV. Second one, profitability index. Profitability index is also called as desirability factor. Okay, can be asked. They can ask us instead of profitability index. They can ask us to calculate desirability factor. We should not scratch our head then. Desirability factor is profitability index. Simple. In NPV, what did we do? Present value of cash inflow minus present value of cash outflow. Correct. Here, this minus is extended as divided by. So present value of cash inflow divided by present value of cash outflow. Simple. That's the profitability index. Advantage here is it is expressed in percentage, relative measure. Right? It's a relative measure. So present value of cash inflow divided by present value of cash outflow is profitability index. So since we are considering cash inflow in the numerator, cash outflow in the denominator, if it is greater than 1, accept the proposal, less than 1, reject the proposal. Less than 1, reject the proposal. So normally NPV and profitability index goes hand in hand in the examination. If profitability index is asked, that means normally NPV will be asked. Because it's an extended version, right? Once you have PV of cash inflow and cash outflow, you can easily calculate both. Advantages. What are the advantages of this? It uses time value of money. That we have to write in all discounted cash flow techniques. Right? It uses time value of money and it's a relative measure. Therefore, the project acceptance or rejection will be based on by even after considering the size of operations as well. After considering the size of operations as well. Yes. Whereas what is the limitation? It fails where projects are not divisible. When projects are not divisible, it will be difficult in the sense the inference that we get, the conclusion that we get in case of profitability index might not be correct. Once a single large project with high NPV is selected, possibility of accepting several small projects which together may have higher NPV, then the single project is excluded. See, now project with higher NPV, one single project, 10 lakh. NPV is, let's say, 1.5 lakh. Whereas you also have 3 smaller projects, 3 lakh, 3 lakh, and 4 lakhs investments, for which NPV that we get is 60,000, 60,000, 40,000. Now, in this case, if I'm by looking at these, I might accept this. But these 3 put together also investment is 10 lakh, but I'm getting 1.6 lakh as NPV. So we might miss out these kind of opportunities. That's the limitation. So a situation may arise where a project with lower profitability index selected may generate cash inflow in such a way that another project can be taken up 1 or 2 years later. So those things also can will have an impact. See, we have 1, 2, 3, 4, 5 years of one project. Profitability index is 1.3. Whereas another project only 1, 2 years, profitability index is 1.2. But after 2 years, I might get one more project where profitability index is 1.5. So in that case, it might be advisable to go with this project now because it ends at the end of 2 years exactly where I'm getting a new project. But if I go with this project next 5 years, I cannot come to this project. Right? So these kind of complex decisions we cannot take using profitability index because it will take only one project at a time. Okay, that's the limitation of profitability index. Is that clear?
Sir.
Yes. Okay. Next one, internal rate of return, IRR. In case of internal rate of return, what is internal rate of return? That is the rate of return at which? Rate of return at which?
NPV is nil.
IRR is the rate at which NPV becomes 0. So it considers the time value of money, obviously. But unlike NPV, it does not use desired rate of return, but we ourselves calculate the discount rate. So in case of NPV, we were calculating, they would have given us the discount rate. We were calculating present value of cash inflow, present value of cash outflow, and then get NPV. But in case of IRR, how do we do this? They ask us to calculate the rate of return. So how do we normally go with IRR calculations? First, we estimate one rate of return. We estimate an IRR. Then we calculate NPV. NPV will definitely not be 0. NPV will either be positive or negative. Correct? If NPV is negative, then I have to take a lower rate. I have to take a lower rate and again discount. Then you might get NPV positive. That means IRR lies between those two rates, for which we will apply interpolation formula. Whereas if NPV was positive in the first instance, you will increase the discounting rate so that you will get NPV negative. So at the end of the day, you should get one NPV positive, one NPV negative. Right? Only then I can say IRR is in between them. Only then I can say IRR is in between them. Then I will apply that interpolation formula. How? First, I will consider lower rate, because between lower rate and higher rate, I have that IRR. So lower rate to lower rate, I have to add something. What is that? I will add NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. NPV at lower rate will always be higher. That is the reason NPV at lower rate minus NPV at higher rate into the difference between higher rate and lower rate. This is the formula of interpolation. This is the formula for interpolation. Is that clear? Yes.
Yes, sir.
So how do we calculate IRR? Summarizing, IRR, first we will estimate our rate of return, 10%, 15%, 20%, correct? And accordingly calculate NPV. That NPV, if it is negative, if that NPV is 0, then you're astrologer. So you're correctly predicted the IRR rate. That's the final answer. But normally it will not happen. So if the NPV is positive, do we go with reduction in the rate or increase in the rate?
Increase in the
Increase in the
Yes. If NPV is positive, you have to further increase the rate to reduce the NPV. The discount rate and NPV are inversely proportional. Higher the discount rate, NPV will be lesser. So now NPV is positive. I want a lesser NPV, increase the rate. And then again discount, right? Normally when you're increasing, how much to increase, sir? At 12%, if I'm getting some, should I go with 13 or 14 or 15? That depends on the amount of positive NPV that you have got, correct? If the positive NPV is lesser, yes, you might go with, no, don't go with 1 increase. Normally go with 2 or 3 increase, preferably 5 increase, right? Then it will be easy. Definitely you will get 1 negative and 1 positive if you have a range of 5, right? So that is how we will do it. Then you will again, you will get another NPV which is negative. You have 1 positive NPV, 1 negative NPV. You know what is the lower rate, what is the higher rate. That formula should be applied to get IRR. However, if NPV was negative, I have to increase NPV, reduce the discount rate. Once I reduce the discount rate and calculate, I get a positive NPV. Then you have both NPVs, both rates, apply the formula to get the IRR. Is that clear? Yes.
Yes, sir.
Now, how do we make decisions? How do we take decisions? We will compare this IRR with your expectation, with your cutoff rate or the weighted average cost of capital. If IRR is greater than your expectation, accept the proposal. IRR is less than your cutoff rate or weighted average cost of capital, reject the proposal. That's what we will do, right? This is the formula. This is the formula that we discussed. Acceptance. If IRR is greater than or equal to cutoff rate or WACC, accept. If IRR is less than the cutoff rate or WACC, reject. Yes. Then reinvestment assumptions. Now, normally in both IRR or NPV discussion, it is assumed that whatever profits or cash flow that we are earning is reinvested in the business. At what rate it is reinvested? In NPV concept, it assumes that it is reinvested at the discount rate. Whereas in case of IRR concept, it is presumed that it is invested at IRR. It is invested at IRR, right? So that's the difference between NPV and IRR. The reinvestment assumption is different. Yes. Now, whenever we have change in pattern of cash flows, when cash flow changes the signs or reverses, then you might have more than one IRR. That means if I get IRR at 8% and IRR of 12% for the same cash flow, that means at 8% and 12% NPV is 0. Right? I might get more than one IRR. That is called multiple IRR. That's one of the limitations of IRR. When cash flows have fluctuations, you might end up with multiple IRRs. Okay. What are the advantages of IRR? It helps, again, time value of money. That's always there. Then all cash flows are considered. NPV and IRR, same advantage. Then IRR is easier to use as instantaneous understanding of desirability can be determined. What you have to do, once IRR is there, you have to just compare with your expectation to get the decision. Then IRR technique helps in achieving maximization of shareholders' wealth objective. That's there. Calculation of IRR is tedious. You have to go with trial and error method. Right, estimate one, take one discount rate, then go with increase or decrease as the case may be. So it's tedious. However, again, if there is fluctuation in the cash flow, there can be multiple IRRs. Then It creates a peculiar situation if we compare two projects with different inflow or outflow patterns. So comparison is normally not possible. Then ignores the firm's ability to receive. Here reinvestment assumption is at IRR rate, but normally it need not be at IRR, it can be at different rates. So ignores the firm's ability to reinvest in portfolios at different rates. In case of mutually exclusive projects, decision based on only on IRR criteria may not be correct. Right? These are the limitations of IRR. Clear? NPV and IRR. So in whatever we have discussed till now, NPV and IRR are extremely important. Extremely important. Then we have furthermore discussions. We have few small concepts. First one that we have is discounted payback period. Discounted payback period. What is discounted payback period? Discounted payback period is similar to payback period. The only thing is instead of cash inflows, we'll be considering discounted cash inflow. Discounted cash inflow cash outflow divided by discounted cash inflow. Present value of cash outflow divided by present value of cash inflow is what we will do to get the payback period. So normally, if 30,000 is a cash inflow, annual cash inflow is 6,000, 30,000 divided by 6, 5 years would have been payback period. But in discounted discounted payback period, what do? We calculate discounted cash inflow, 6,000 rupees, 10 years, I think is the project life. Yes. Then they have given 15% discount rate. You will calculate the interest discount factor, present value, then cumulative present value, by which you will get 30,000 somewhere here, between 9 and 10. So you have to extrapolate and calculate. So they have written approximately 10 years. Right? That's how discounted PVP will be calculated. Then the last concept is MIRR, modified IRR. This is also called as terminal value method. Important. Modified IRR is also called as terminal value method. This is why it is called terminal value, because it follows ulta approach, wherein normally what do? We calculate present value. Here it will calculate future value. Right? Present value means what? Today's value of all future cash inflows. But here what they do is they'll calculate all cash inflows value at the end of the life, future, so that all cash inflows will have value as on terminal year, last year, except initial cash outflow. Except initial cash outflow, all cash inflows will have the value as on the terminal year. So we will calculate future value. Ulta approach will be followed. MIRR addresses some of the deficiencies of IRR, eliminates multiple IRR rates, addresses reinvestment rate issue, and produces results which are consistent with NPV. Calculation will not be asked. However, the concept can be asked in the exam of modified IRR. Right? All cash flows apart from initial investment are brought to terminal value using appropriate discount rate. This results in a single stream of cash flows in the terminal year. So in terminal year, we will have one cash flow. All cash flows are brought in that time period. Right? It is obtained by assuming a single outflow in the 0th year and terminal cash flow as mentioned above. So one outflow at the beginning, one inflow at the end. That is what they do. That's what they calculate. Correct? Yes. The discount rate which equates the present value of terminal cash inflow to 0th outflow is called MIRR. Then what they do is they will calculate the present value of terminal cash inflow. So what they did, year 1, 2, 3, 4, 5, 6, 7, all cash inflows, they will calculate the terminal value, future value. Now you get one value, one cash inflow, one cash outflow. So whatever this one cash inflow is there, calculate its present value. Instead of calculating present value of multiple, calculate present value of one cash inflow, then equate at which rate it becomes 0. That's the rate of MIRR. If MIRR is larger than the required rate of return, accept, lower than the required rate of return, reject. Okay, when we compare between NPV and IRR, why normally in most of the cases, NPV and IRR will be the same, will go hand in hand. But in some cases, there might be difference in the conclusions that we get. Why? One is scale or size disparity. IRR is a relative measure. We go with percentage. NPV is absolute measure. We go with value. So we might get a different conclusions because of scale or size disparity. Then time disparity in cash flows. then you unequal life, disparity in the life of the proposal. Because of that also we might get different conclusions. In case of unequal lives, what we have to do? That means first one project is 5 years, one project is 7 years. In that case, if the projects are independent of each other and are divisible in nature, then what you have to do is you have to go with NPV per rupee capital. Based on that, you have to rank. Project should be ranked based on NPV per rupee capital. Total NPV divided by total investment. It will give you NPV per rupee. Correct? NPV per rupee. So based on that, you will rank which project to be selected. If project is not divisible, then you have to go with absolute NPV only. It should be mixed up such that highest NPV project will be given first, then next NPV, next highest would be given second, until your resources are exhausted. Until your resources are exhausted. That's how we will do in case of unequal lives. Alternatively, we have two methods that we can follow in case of unequal lives. Replacement chain method. That means by bringing them to common life. If one project is 3 years, one project is 6 years, bring this project also to 6 years or bring this project to 3 years so that it will be easy to compare. If one is 3 years, one is 5 years, bring this to 15 years, bring this to 15 years, multiply. Right? Into 5 into 3. Bring them to common lives and then compare. That is replacement chain method. Or equivalent analyzed criteria. This is what normally will be followed. This is important. Examination point of view. This is important. Problems can be asked. Equivalent annualized criteria. Here what do we do is first you calculate NPV normally. Compute NPV using WSCC or discount rate. Compute present value annuity factor. Now, let's say NPV for 5 years put together. For 5 years, NPV is 50,000. Now, all those 5 years you have calculated the discount factor. Discount factor. Add up those discount factor, you get present value annuity factor. Divide the NPV with present value of annuity factor, you will get NPV for 1 year. Okay, that is equivalent annualized criteria, bringing it to 1 year NPV. So in both the cases now, unequal lives, you have brought the NPV to 1 year. Easy for comparison. So simple. In equivalent annualized criteria, what do we do? First calculate NPV as it is. Second, add up all the discount factors, you get PVAF, present value annuity factor. Then NPV divided by PVAF, present value annuity factor, you get what? You get the NPV for 1 year, which can be used for comparison. Is that clear? Yes. That the first chapter is done. Okay. So write down. In case of unequal cash flows, unequal life. In case of unequal useful life, below that, two arrow marks, replacement chain method, right hand side, equivalent annualized criteria. Equivalent annualized criteria. Equivalent annualized criteria. Now, below replacement chain method, evaluation by bringing such unequal lives to common life. Evaluation by bringing them to common life. Bringing such unequal lives to common life. Then below equivalent annualized criteria, point number 1, compute NPV. Point number 1, compute NPV. Point number 2, calculate present value annuity factor, PVAF. present value annuity factor within brackets total of all discount factors. Total of all discount factors. Point number 3, EAC is equal to equivalent annualized criteria. EAC is equal to point number 1 divided by point number 2. 1 divided by 2. That is NPV divided by PVAF. NPV divided by present value annuity factor. Am I audible?
Yes.
Yes,
Yes.
sir.
Yes, sir.
Yes. Okay. Am I visible?
Yes,
Yes,
sir.
sir.
Yes, sir.
Yes, sir.
Okay. So that's how we calculate equivalent annualized criteria. Is that clear?
Yes, sir.
Yes. With that, investment decisions, all the concepts we have discussed. Any doubts in this? No. Fine then. Can we look into some problems?
Yes, sir.
Yes, sir.
Yes, sir.
Yes. Okay. First one is our RTP, November 23 RTP. PQR Limited is considering buying a new machine which would have a useful economic life of 5 years at a cost of rupees 40 lakh, scrap value of 5 lakh, with 80% of the cost being payable at the start of the project. So what would be the cash outflow at the start of the project?
2 lakh.
40 lakh into 40 lakh into 80%. 80% is being payable at the start of the project and 20% at the end of year 1. So there will be 2 outflows at end of year 0 for 32 lakh. At the end of year 1, balance 8 lakh. Correct? Balance 8 lakh. Yes. The mission would produce 80,000 units per annum of a new product with an estimated selling price of rupees 400.
Sir.
Direct cost would be 370 contribution. Not that.
This is breaking.
You speak, we know, can't hear.
Am I audible?
Yes, sir.
Yes,
Yes,
sir.
sir.
Yes, sir.
Yes. Okay. Fine. Right. Okay. Fine. So what are they telling? Machine produce 80,000 units per annum of a new product with an estimated selling price of 400 per unit. Direct cost is 375. So what would be the contribution per unit?
25.
25
25.
rupees. Total contribution would be 25 into 80,000. Correct? Yes. 25 into 80,000 will give you total contribution per annum. Minus annualized fixed cost, including depreciation calculated on SLM, 10,40,000. 10,40,000 is the fixed cost. But for this, from contribution, can I reduce 10,40,000 in full? Shall I reduce 10,40,000 in full?
Yes,
Guys, are we
sir.
there?
Sir,
Okay.
other than depreciation.
See, what are they asking us? NPV calculation. To calculate NPV, what is required? Cash flows after tax. To get this cash flow after tax, I am in contribution now. I have contribution. So I know 10,40,000 is the fixed cost, including depreciation. Should I reduce full 10,40,000? Is my question.
No, sir.
Sir, no, sir.
No, sir.
The answer is correct, Naman. We have to, at this point, we have to reduce full fixed cost. Why? Because depreciation is tax deductible expenditure.
Yes, sir.
Correct. So full fixed cost of 10,40,000 should be reduced to get profit before tax. Then no, it's not profit before tax because we have some more expenses here. In the first year and the second year, special sales promotion expenditure not included above 1,25,000 and 1,75,000. This is applicable only for first year and second year. Total number of years is 5.
5 years.
5.
Correct. So you should have 5 different columns now. Contribution will be common. Once you can start from contribution directly. Contribution will be common. So contribution minus fixed cost 10,40,000 will be same for all 5 years. But this additional expenditure 1,25,000 for first year, 1,75,000 for the second year will give you profit before tax. Then have they given us the tax rate?
No, sir.
No, they haven't given us the tax rate. So what shall we do?
Add back the
We will we can directly add back the depreciation. Tax rate is not given. So in that case, in this scenario, we might directly exclude the depreciation because tax rate is not given. We have to give a note on that. Since tax rate is not given, we are directly considering that. So what would be the depreciation? 40 lakh is the cost. They are telling straight line method. 40 lakh divided by 5, 8 lakh. So 10,40,000 in that 8 lakh is depreciation.
Scrap value is this.
Scrap value is there. Correct. So 40 lakh minus 5 lakh, 35 lakh divided by 5, 7 lakhs. Correct. So 10,40,000 minus 7 lakh, 3,40,000 is the balance fixed cost. Yes, correct. Good point. So you're calculating net cash flows 32 lakh year 0, 8 lakh year 1. Then contribution minus fixed cost for the first 2 years extra expenditure. And last year, this scrap value will be an inflow. This gives you the cash flows. They have given us the 12% rate. Calculate present value. You will get NPV. Everyone understood?
Yes,
Sir.
sir.
Yes, sir.
Yes. Okay, next, I'll move on to one more question. See, this is May 23 RTP. Dharma Limited, an existing profit-making company, is planning to introduce a new product with project life of 8 years. Initial equipment cost will be 240 lakh. Additional equipment costing rupees 26 lakh will be needed at the beginning of third year. Beginning of third year means end of
Second year.
India.
second year. We have to be careful there. At the end of 8 years, original equipment will have resale value equivalent to the cost of removal. That means
Scrap.
zero. Residual value, salvage value is 0. Whatever we get by selling it, we are utilizing it for cost of removal. So scrap value will be 0, salvage value, correct? But additional equipment will be sold for 2 lakh rupees. So additional equipment, whatever we had, that will have a salvage value of 2 lakhs. So that will be a cash inflow at the end of 8 years. Working capital of 25 lakh will be needed at the beginning. So beginning 240 plus 25, 265 is the outflow. Then 100% capacity of the plant is 4 lakh per annum, but production and sales volume expected as under year 1 to 3 to 5 and 6 to 8, 20%, 30%, 75 and 50. Accordingly, we know the units produced and sold. Correct? Yes. Sale price of 100 per unit with a PV ratio of 60%. That means directly I'll get contribution is 60 rupees. 60 rupees. So I know the numbers, units sold per year into 60 rupees. I'll get the contribution of that year. Then fixed operating cash costs are likely to be 16 lakh. Cash cost directly given. Fixed operating cash cost. So 16 lakh. In addition to this, advertisement expenditure will be incurred. These are the advertisement expenses should be reduced. Company is subjected to 50% tax rate and 12% cost of capital. Straight line method of depreciation is followed. Advise the management on desirability. Since tax rate is given, we should also consider depreciation. Depreciation is not included in this because this is cash cost. So separately, we have to calculate depreciation. Are we understanding?
Yes, sir.
Yes, sir.
Yes.
Yes. So first we have to calculate cash flow after tax. They have given us that capacity, number of units produced, multiplied by 60, you'll get contribution, fixed cash cost. Then depreciation on original equipment, 240 lakh divided by 8 lakh because scrap salvage value is 0. 240 lakh by 8 years. Whereas additional equipment cost was 26, salvage value is 2, 26 minus 2, 24. Divided by 6 years because it was purchased at the end of second year. 3, 4, 5, 6, 7, 8, 6 years. Correct? Correct, Subiksha? Yes. So 24 lakh by 6, you get only from third year. First 2 years, no depreciation. We have to be careful there. Then advertisement expenditure as given in the question, this gives you PBT. from that tax rate, the tax rather. So right, for first case, 28 lakh loss, so that gives you tax savings of 14 lakh. Tax savings of 14 lakhs, balance or tax expenditure. So profit after tax taken, add back depreciation because it's a non-cash expenditure. You will get cash flow after tax. Is that clear?
Yes.
Yes, sir.
Yes. From that, you will get cash flow after tax. You know, initial investment. Initial investment first year is 240 plus 25, 265. Then cash flow after tax of every year. At the end of year 2, additional equipment of 26 lakh. We have to be careful there. Then cash flow after tax every year. Last year, nothing is given about working capital. Right? Initially, they said working capital of 25 lakh is needed. But nothing is given with regard to working capital. How much was utilized? Nothing. That means that entire 25 lakh will be released at the end of 8th year. At the end of 8 years, entire working capital is released. That new machinery was sold for 2 lakh. Thereby, you get NPV, net present value. 12% is the percentage given, I think. Rate. Yes, 12% is the cost of capital. Is that clear?
Yes, sir.
Write down. Write down. Working capital. Initial working capital required. Initial working capital required shall be treated as cash outflow at the start of the project, year 0. Additional working capital required shall be treated as cash outflow at the start of the project. At the start of the project, year 0. Year 0. Below that, if subsequent information is given with regard to, if subsequent information is given with regard to, if subsequent information is given with regard to additional working capital is required, additional working capital is required, or reduction in the working capital, then adjustment should be made accordingly in such year. Then adjustment should be made accordingly in such year. What does that mean? If they say at the end of year 3, additional working capital of 3 lakh, then that would be a cash outflow of year 3. If they say reduction in working capital of 2 lakh at the end of year 7, then at the end of year 7, that will be cash inflow. Full stop. However, if nothing is given, then initial working capital invested shall be taken as release of working capital. Initial working capital invested shall be taken as release of working capital at the end of the project. At the end of the project. Mark this, very important, because we might miss this. Working capital initially given, so we'll take it as outflow. But inflow, we will miss it. Right? Chances of missing is there. So, very, very important point. Clear with this question?
Yes.
Yes, sir.
Sir, can you repeat that release part, sir? Release of working capital. I didn't understand.
You didn't understand. So you want me to explain. Correct?
Yes, sir.
Yes. Okay. Simple. See, what did we do with the working capital invested 25 lakh at the beginning? We showed it as outflow. Now, what is this working capital? Working capital is the amount that we set aside for day-to-day operations, and it keeps on fluctuating. So day-to-day operations for paying salary for the person who is maintaining that machinery, rent, right? So various expenses incurred. So that initially we have invested 25 lakh. During the life, it might increase or decrease. If there is increase or decrease, accordingly adjustment we will do. However, if nothing is given, that means that 25 lakh is intact every year. So at the end, once the project is over, that 25 lakh is no more required. That means
Yes,
that
sir.
25 lakh comes back to me. It's an inflow for me. Therefore, we have
Yes,
to
sir.
consider as an inflow.
Yes, sir.
Yes. Okay, fine. Right. Shall we look into the next question?
Yes, sir. Yes, sir.
Yes. This is November 22. November 22 question paper. Yes, question paper of November 22. A hospital is considering to purchase a diagnostic machine. This is we had discussed in the class. 80 rupees, 80,000. Projected life of the machine is 8 years. Expected salvage value of 6,000 at the end of 8 years. Annual operating cost of the machine is 7,500. If it is expected to generate revenue of 40,000 per year for 8 years. Presently, hospital is outsourcing the diagnostic work and is earning commission income of 12,000 per annum. What is this? What is this? Opportunity cost. Correct. See, presently they don't have that machinery. So any leads they get, they will refer it to that diagnostic, whatever diagnostic shop is there. So for that, they are getting commission of 12,000 per annum. Now, if they themselves have that diagnostic machine, this commission is gone. They'll not get that commission. Correct. So it's the opportunity cost. Consider tax rate of 30%, discounting at 10%, whether it is profitable for the hospital to purchase the machine. That means they have to get a NPV more than this, more than their opportunity cost. Only then they can go ahead with that. Correct? Yes. So how do we do this? They have given 10% discount rate. Okay, fine. So this life is 8 years. Salvage value of 6 years at the end of 8 years. That means for first 7 years, I'll be getting 40,000 per annum. 8th year, along with this 40,000, I'll also get the 6,000. Correct? So up to 7 years, 40,000. Operating cost is 7,500. They themselves have given us 32,500. Depreciation 80,000 minus 6,000 divided by 8. 9,250. Net income, tax at 30%, earnings after tax, add back depreciation, cash flow after tax. Now they have given us two scenarios. If commission income 12,000 rupees is before tax, commission income 12,000 rupees is after tax. If 12,000 is before tax, net income will be 12,000 into 70% because 30% tax rate. So first case before tax, they are considering that opportunity cost as 12,000 into 70%, 8,400. Whereas if it is after tax, full 12,000. In that case, every year my net cash flow, net benefit that I am getting is 17,125, 13,525. Whereas in the 8th year, my net cash flow after tax, along with that, I will also get 6,000 rupees extra salvage value. So last year cash inflow is 23,125, 19,525. First 7 years, these are the cash inflows that we have to calculate the present value. For first 7 years, this is the PV factor. How did we get the PV factor? We have to just add up 7 years. Correct? PV factor. So you will get present values. Last year's factor, you will get the total present value of cash inflows. Present value of cash outflow 80,000. If it is before tax, I'm getting a positive NPV. If it is after tax, I'm getting negative NPV. Is that clear? Yes. So depending on whether it is before tax or after tax, our decision might change. So they're asking us NPV as well as PVI, present value index method. What is present value index method?
Desirability factor.
Yes, profitability index, PI, right? Present value index, desirability factor, profitability index. There are 3 different terminologies used. So profitability index is what? Present value of cash inflow divided by present value of cash outflow. 1.18, 0.94. Accordingly, recommendation is a must, right? So hospital may consider purchasing the diagnostic machine where commission income is before tax. However, if it is after tax, do not purchase the machine. Go ahead with whatever you are doing, outsourcing. Correct? Yes, that's the solution for that question. We'll look into one more question. May 22 RTP. A, B, C and Co is considering whether to replace an existing machine or to spend money on revamping it. A, B, C and Co currently pays no tax. Replacement machine cost is 18 lakh rupees now and requires 2 lakh rupees maintenance at the end of every year for 8 years. At the end of 8 years, it would have a salvage value of 4 lakh and would be sold. Existing machine requires increasing the amount of maintenance each year and its salvage value falls each year. Existing machine presently 0 maintenance, salvage value 8 lakh. 2 lakh maintenance, 5 lakh salvage value, 4 lakh, 6 lakh, 8 lakh. Maintenance increases, salvage value decreases. That replaced machine presently 18 lakh cost, maintenance 2 lakh fixed. It will not increase. Salvage value after 4 years, 4 lakh fixed. Right? Opportunity cost of capital is 15%. What should we do? We should see when the company should replace the machine, whether it should replace now or at the end of 1 year, end of 2 years, end of 3 years, or end of 4 years. They have given us the present value interest factor also. If they have given the present value interest factor, you have to consider the same, irrespective of the decimals that they have. The same decimal numbers you have to consider. If they have not given us 4 decimal points. Not given us 4 decimal points. Yes. So here, what are they doing is they're calculating equivalent annualized cost of the new machine. New machine, 18 lakhs. Why they're calculating equivalent annual cost? Because existing machine is only for 4 years. New machine is for 8 years. Right? So that new machine, cost of the new machine now is 18 lakh. Repair 2 lakh per annum for 8 years. What is its present value? 2 lakh into this additions. 8,97,460. So this is the total cash outflow. Present value of the salvage value. Salvage value at the end of 8 years is 4 lakh. What is its value today? Present value of cash inflow. So 25,66,700 divided by, how do you get equivalent annualized factor? NPV divided by present value annuity factors. So this addition, which is 4.4873, you'll get equalized annual cost as 571,992. This is the cost. Now coming to existing machine, year 0, if I replace immediately, my cash outflow is this 571,992, present value of cash outflow. Whereas, what is my cash inflow? 8 lakh. Salvage value of the machine today is 8 lakh. Cash inflow is 8 lakh. Today's value, present value will be the same. Am I audible?
Yes, sir.
Yes, sir.
Yes. So net, the benefit that I get is positive. Net benefit that I get is positive 2,28,008. Are we understanding this?
Yes, sir.
Yes, sir.
There's a lag in your
Whereas
video.
if I replace at the end of year 1, what happens? I will pay 571,992.
Sir,
There's a lag.
Sir, lag.
Is it better?
Could you speak a little more?
I think it is still lagging.
Yes, sir.
Yes.
No, it's not lagging like this. No, the video is lagging.
Okay, now
It's
I don't think so.
Audio is not lagging, sir.
Yeah, I think now it is better.
Sir,
Some issue. I'm there. Just give me a second.
yes, sir.
Am I audible?
Yes, sir.
Yes, sir.
Listen.
Sir.
Yes. Okay, I think because of Sunday evening there is a network issue. Okay, fine. So everyone understood the year 0?
Yes,
Yes,
sir.
Yes, sir.
Yes, sir.
What I'm doing? I'm investing 571,992. I'm getting 8 lakh rupees by selling the old machinery. So net benefit. Whereas if I replace at the end of year 1, what happens? I have to shell out 571,992 plus first machinery. There is a maintenance of 2 lakh and salvage value reduced to 5 lakh. So what is the net benefit? Minus 2 lakh, 5 lakh. And I cannot directly take 571, 2 lakh and 5 lakh. I have to take present value because it is after 1 year. So present value, if you take, I'll get negative benefit. It's a cost. It's a loss. Same way, year 2. When I replace at the end of year 2, year 1, I have incurred 2 lakh as maintenance for the first mission. Year 2, I'm incurring 4 lakh as maintenance plus outflow for this particular machinery at the end of year 2. Plus I'm getting 3 lakh rupees as salvage value. So again, loss. Same way, year 4, loss. Year 5 also loss. So what is the best way? Replace immediately. Replace immediately. Are we understanding?
Yes, sir.
Yes, sir.
Yes, sir.
Right? So these kind of questions also will be asked. Now, simple. See, what you have to do is you have to just solve all the problems that's there in this material. It's a compilation of all RTPs, MTPs, and question paper, right? Normally, questions will be repetition. In the sense, the pattern of the questions will be repeated in FM. So, there will be very rarely that the new pattern would be created by them and asked. So, normally it will be the same. So, it's always better if we are thorough with all these problems. Definitely, it will be the same kind of problems that will be asked. And if we are thorough with these problems, you'll get full marks. That's the advantage, right? You'll get full marks because you will have gone with the same flow and you'll get the correct answer, right? So that's one thing. And along with these problems, please don't forget theory questions. See, July 21, explain the limitations of average rate of return. We have to write the limitations, right? Here in this chapter, there was only one question asked till now as theory. Okay, with this, we are done with the first chapter, an important chapter. Okay, we have gone in depth, in detail. The other two chapters are not so detailed, right? So the first chapter is very, very detailed. So we have gone in detail. Any doubts in this?
No.
No. So we have gone in depth with regard to the concepts. What you have to do is you have to solve more problems from this chapter. That's it. That is what is required. Okay. Now, before looking into second chapter, do we need a break?
Sir. Yes, sir.
Okay.
Yes,
Some of
sir.
us are telling no. Okay. We'll go with, I thought of giving 10 minutes. We'll give 5 minutes break then. Okay. Take a break. We'll come back at 8:20.
Yes,
Yes.
sir.
Okay.
Thank you,
Fine.
sir.
Guys, are we all back?
Yes, sir.
Yes, sir.
Yes, sir.
Yes. Okay, fine. We'll look into the next chapter. Chapter 2, risk analysis in capital budgeting. Right? Whatever we have learned, capital budgeting, here we have an extended discussion. Here we'll focus more on risk, uncertainty. So for that, cash flows can be, or decision making can be divided into 3 different categories. For this purpose, decision making can be divided into 3 different categories. What are the 3 different categories? Decision making under certainty. What does this mean? Where cash flows are certain. We don't have any issue here. Cash flows are certain. Decision making involving risk. What do we understand by this? Here, cash flows involve risk. That means whatever I'm getting, the cash flows that I'm predicting, that we might not receive. However, we can allocate probability. We can assign probability. Probability can be assigned. However, third one is decision making under uncertainty. Under uncertainty, we have cash flows are uncertain. We do not know at all. Here, at least we know, but it involves risk. Here, cash flows are uncertain and probability cannot be assigned. Probability cannot be assigned. Is that clear? Yes. So these are the 3 cases. What's the difference between risk and uncertainty? In risk, the probability distribution of cash flows is known. That means you know what are the cash flows that you can get. You can either get 500 rupees, 800 rupees, or 1000 rupees. You know the cash inflows that you can get, and you know the probability of getting such cash flows. That is a situation of risk. Whereas in case of uncertainty, you do not know what you get. It's not predictable at all. Right? So uncertainty is probability distribution is not known. That is uncertainty. Okay, that's about uncertainty. And risk. That's the difference between risk and uncertainty. Which is the best measure of risk? Standard deviation. Right? Standard deviation is the best measure of risk. Yes, risk is done. Reasons. Why do we adjust this risk in capital budgeting decision? Important. Once asked in the exams. Here, there is an opportunity cost involved. Whenever we are investing in one particular machinery, there is an opportunity cost involved. That opportunity cost has to be adjusted for. That is the reason. Well, that is one of the reasons. Second, risk adjustment is required to know the real value of the cash flows. Higher the risk, you are expecting higher the return, higher returns, right? So to get the real cash flows, you will adjust the risk. What are the sources of risk? There are various sources. Project specific risk, company specific. Project specific means for that particular project, in the nuclear power project of a power generation company has different risk than hydel projects. Company specific risk is for that company as a whole, right? Then industry specific risk is for that entire industry. Market risk for whole market. Competition risk because of rivalry, competitors. Risk due to economic conditions. Inflation, change in GDP, change in savings and net disposal of income. Then international risk is geopolitical conditions, bilateral agreements between the countries, right? Recessions, etc. So these are the various risks that the business can face, because of which the cash flows might change. Cash flows might have an impact. So for this, analyzing these risks, we have various techniques. We have statistical techniques, conventional techniques, other techniques. Statistical techniques, we have probability, standard deviation, variance, coefficient of variation. Variation is hidden. Coefficient of variation, you can write it there. So all these 3 we have, those who are from foundation, we have learned it in foundation. Statistics, probability, variance, standard deviation, and coefficient of variation. We have also learned in FM also, in inter classes. Okay, those who have forgot statistics in foundation. Then conventional techniques, we have RADR, risk adjusted discount rate, risk free rate plus risk premium, RADR. Then certainty equivalent, removing the risk from the cash flows, calculation of risk free cash flow, certainty equivalent. Then other techniques, sensitivity analysis, by changing one of the variable, how much does the NPV change? Sensitivity analysis. Scenario analysis, by changing many variables, what is the change? What is the impact? That's the scenario analysis, right? These are the various techniques involved. Probability, first one. What is probability? Study of chance, right? Measure about the chances that an event will occur. If probability is 1, we call it certain event. If probability is 0, impossible event. Here, what do we focus on is expected value, expected net cash flow, expected NPV. These are the two terms that we will focus on in probability. How do we calculate expected net cash flow? You have, let's say, likely cash flows as 10 lakh, 12 lakh, 15 lakh. Their probability is 0.3, 0.4, 0.3. How do I calculate expected cash flow? Will be 10 lakh into 0.3, 3 lakh, 12 lakh into 0.4, 4.8 lakh, 15 lakh into 0.3, 4.5 lakh, right? So this would be the expected net cash flow. Expected value concept, which we have learned in foundation statistics. Same concept, what likely cash flow into probability will give you expected net cash flow. Once you get expected net cash flow, what you have to do is expected net cash flow divided by 1 plus k to the power of t. You will get present value of net cash flow. Discounting, simple. Expected net cash flow, you have to discount. You will get present value of expected net cash flow. Reduce that from cash, reduce cash outflow from that. You will get expected NPV. You get expected NPV. That's the point, right? Expected net cash flow is the sum of likely cash flows of the project multiplied by the probability of the cash flow. Expected NPV will be present value of expected net cash flow minus cash outflow. Present value of cash outflow. Okay, that is missing. You can write this off. Present value of expected net cash flow divided minus cash outflow. How do you calculate present value of expected net cash flow? Expected net cash flow divided by 1 plus k to the power of t summation. You have to just calculate the discount rate. 1 plus k is discount rate to the power of t depending on the time. Everyone, are we getting this?
Yes, sir.
Yes. So whenever they're asking us expected NPV, first we have to calculate expected net cash flow. They would have given us likely cash flows. They would have given us probability. Likely cash flow into probability, sum total will give us expected net cash flow. Calculate present value of that. Then they would have given us cash outflow, reduce it, you get expected NPV. That is the first one, probability. This is what will be asked in probability. Then comes variance. What is the formula for variance? Summation f into x minus x bar the whole square. That's variance. Correct? Now, here, instead of f, since we are using the concept of expected value, we get probability. P into x. What is x here? Net cash flow. What is x bar? Expected net cash flow. The whole square. That's all. Net cash flow minus expected net cash flow, the whole square, into the probability, sum total will give us variance. That means, in the example that we had cash flows of 10 lakh, 12 lakh and 15 lakh. 0.3, 0.4, 0.3. So we get 3 lakh, 4.8 lakh and 4.5 lakh. Correct? What is the expected cash flow?
12.3 lakh.
12.3 lakh. So how do I calculate variance? This is net cash flow, likely. This is expected cash flow. So X net cash flow minus expected cash flow. X minus X bar, the whole square. So 10 minus 12.3, the whole square. 12 minus 12.3, the whole square. 15 minus 12.3, the whole square. Then what we would do? F into X minus X bar, the whole square. So NCF minus expected cash flow, whole square, into here instead of F, P. So that into 0.3, 0.4 and 0.3, you'll get that summation. That itself is variance. That is the variance, square root of that standard deviation. So variance helps us to understand the level of risk it might face, a project might face. Are we clear with this? Yes, everyone, are we there?
Yes, sir.
Yes,
sir.
Yes, sir.
Okay, fine. Now, what is the importance of this variance and standard deviation? It helps us in understanding the volatility, right? Volatility in the estimated cash flows and profitability in an investment proposal. Variance measures the range of variability in the cash flow, whereas standard deviation helps in determining the risk. Variance helps us to determine variability, fluctuation in the cash flow. Standard deviation helps to determine the risk. Right? An investment proposal in which expected cash flows are close to the estimated net cash flow are seen as less risky, potential to make profits. Variance is prerequisite for calculating standard deviation because standard deviation is square root of variance. So it's a prerequisite. Coefficient of variation, we know standard deviation by arithmetic mean into 100. That's the formula. Am I audible?
Yes, sir.
Yes, sir.
Audible, sir, but video is lag.
Video is done.
Yes. It is still lagging.
Yeah.
Yes. Okay. Am I audible?
Yes, sir.
Yes.
Audible, sir.
Yes, yes. Okay, fine. So what were we discussing about? We were discussing about coefficient of variation. In case of coefficient of variation, what is the formula for coefficient of variation? Standard deviation by arithmetic mean into 100. That is what we learned in foundation. Correct? But here, instead of arithmetic mean, since we are using expected value, it will be standard deviation by expected value into 100. Expected net cash flow into 100. Is that clear?
Clear, sir.
Yes.
Yes.
Yes. So where do we use this coefficient of variation? For comparison, because coefficient of variation is a relative measure. Right? It's in percentage. Since it's in percentage, comparison becomes possible. Coefficient of variation calculates the risk borne for every percent of expected return. So it is expressed in percentage. It is expressed in percentage. Then it enables the management to calculate the risk borne by the concern for every unit of estimated return from a particular investment. Okay. Then project having lower coefficient of variation is to be selected. Very important point. So when it comes to selection, project having lower coefficient of variation because lesser risk. Lower coefficient of variation to be selected. Yes. Then we have a few conventional techniques. One is RADR. In RADR, what do we do is you calculate risk adjustment discount rate, which is nothing but risk-free rate plus risk premium. Risk-free rate plus risk premium. Risk-free rate is the rate of return for risk-free investments like bank deposits, government bonds, etc. Risk premium is the compensation for taking extra risk. Compensation for extra risk. This they will give. RF, risk-free rate is 7%. Risk premium is 7%. Calculate RADR. What would be the RADR?
14%.
14%. Correct? RADR would be 14%. Now, RADR is not a technique independently. RADR, we will calculate RADR, we'll get the discount rate, we will use that discount rate to calculate NPV. We'll use that discount rate to calculate NPV. So they can ask you to calculate NPV under normal discount rate, calculate NPV under RADR. Right? In that case, you have to calculate RADR, use that rate to compute NPV. Use that rate to compute NPV. What's the advantage? It's easy to understand. Calculation of risk premium, risk-free rate. It's easy to understand. However, it incorporates risk premium in the discounting factor. However, how do you find that risk premium? Difficulty in finding risk premium. That's the disadvantage. However, you can calculate NPV, but using RADR, you cannot calculate standard deviation. Standard deviation cannot be computed. That's the limitation. Next, what we have is certainty equivalent. What is the certainty equivalent? Here, it's an approach for dealing risk. What do we do is from risky cash flows, we will remove the risk so that it becomes riskless cash flow. How do I remove the risk? By multiplying certainty equivalent. Now, if certainty equivalent is 1, that means that it is risk-free cash flow. If certainty equivalent is 0.7, that means there is 30% risk. So if the cash flow is 1 lakh, how do I get risk-free cash flow? 1 lakh into 0.7, 70,000. That's how we get risk-free cash flow. Again, certainty equivalent is not a technique as such. Using certainty equivalent, we'll calculate risk-free cash flows. Then we will calculate NPV using that risk-free cash flows. Okay, so RADR and certainty equivalents help us in getting a value using which we will calculate NPV. Using which we can calculate NPV. Yes. So it involves expressing risk-free future cash flows in terms of certain cash flow, which would be considered by the decision maker as their equivalent. That is, the decision maker would be indifferent between risky amount and riskless amount considered to be its equivalent. That means investing 1 lakh in that investment or investing 70,000 in a risk-free cash flow, risk-free investment is one and the same. That is what risk-free, this certainty equivalent concept is all about. Okay, it is a guaranteed return that the management would accept rather than accepting a higher but uncertain return. It is a approach. In this approach, a set of riskless cash flow is generated in place of original cash flows. So we will calculate riskless cash flows. How do we do that? Remove the risk by substituting equivalent certain cash flows from risky cash flow. How do we do this? Multiplying risky cash flow by appropriate CE coefficient. That is what we did. 1 lakh into 0.7, 70,000. That's how we calculate riskless cash flows. Yes. So on tossing of a coin, if it comes head, you will win 10,000. If it comes to be tail, you will win nothing. Expected value will be 10,000 into 0.5, 5,000. Right? However, if you want riskless cash flow, 10,000 into the corresponding CE coefficient. Whatever is given in the question, that they will give. We need not worry about that. CE coefficient. Discounted cash flow, discounted value of the cash flow is obtained by applying riskless rate of return. Only risk-free rate will be applied in this case, not RADR. Why? Because the cash flow that we have is also risk-free cash flow. So since we have risk-free cash flow, we will apply risk-free rate of return only. Are we getting this?
Yes, sir.
Yes, sir.
We have that. Once we have present value of cash inflow, you know present value of cash outflow, calculate NPV. That's simple. That's the same thing. Right? Write down in certainty equivalent. In certainty equivalent, since we are removing the risk involved in the cash flow, since we are removing the risk involved in the cash flow by applying CE factor, the resultant value that we get, the resultant cash inflows that we get, the resultant cash inflows that we get will be risk-free cash flows. Therefore, while calculating NPV, we will apply risk-free rate of return. We'll apply risk-free rate of return and not the discount rate or RADR. And not the discount rate or RADR. Clear?
Yes, sir.
Yes. So that's the certainty equivalent. That's the steps. Coming to the advantage, it is simple and easy to understand. It can be easily calculated for different risk level because all risk level cash flows we are bringing into riskless cash flows. So it is easy when we have different risk levels. But disadvantage is, how do you get that certainty equivalent? There is no standard approach for calculating or estimating certainty equivalent. It is subjective. Therefore, that's the disadvantage, and certainty equivalent is dependent on the risk perception of the management. Obviously, it is subjective. Risk perception of shareholders is ignored. Okay. When we compare the RADR versus certainty equivalent is more superior as it removes the risk altogether. Therefore, certainty equivalent is more superior. Each year certainty equivalent coefficient is based on level of risk impacting its cash flow. However, it's not, as it is too difficult to specify a series of certainty equivalents. Certainty equivalent calculation is subjective, therefore it is not preferable. Then we have two more techniques, important ones: sensitivity analysis, scenario analysis. In case of sensitivity analysis, what do we do? Here, changes are made to significant. Now we have computed NPV normally. Then we make changes to one of the variables, say sales decreased by 10%. Variable cost increased by 10%. Depending on that, what percentage NPV changes? That is what we analyze in sensitivity analysis. However, the limitation here is we can change only one variable at a time. So sensitivity analysis is a modeling and risk assessment procedure in which changes are made to significant variables in order to determine the effect of these changes on the planned outcome. Technique used to study the impact of the changes in variables on the outcome of the project. Project outcome is studied after considering change in only one variable. The more sensitive the NPV, more critical is that variable. So thereby we can identify which variable is more critical. That means which is that variable which has resulted in more change in NPV. That is the most critical variable. So that will be easy for them to focus. Right? Therefore, sensitivity analysis is a way of finding impact on the project's NPV for a given change in one of the variables. What are the steps? First, identify which are the variables which will impact NPV, like selling price, variable cost, right? So thereby we will identify. So various discount rate, right? All these are the variables which will have an influence on NPV. Establish a mathematical relationship between the variables. Analyze the effect of change. You fix a rate, 10% decrease, 10% increase. So each variable, analyze change of that percentage, analyze the change in the NPV. What's the advantage? It helps us identify the issues which are critical for the project. That variable which is most critical, we can easily identify. Then it's a simple technique. Whereas disadvantage is, it assumes that all variables are independent. Since we are going with one variable each, other variables are independent. That is what we are presuming. Other variables are not changing, but that need not be the case. Right? When selling price increase or decrease, other things might also change. Demand might also change. But here they are telling all variables are independent. It does not look to the probability of change in the variables. Other variables are considered fixed. However, in scenario analysis, we can change multiple variables. This brings in probability of changes in the key variables and also allow us to change more than one variable in it at a time. That means that disadvantage of independence of all variables is removed here. Correct? Multiple variables can be changed at a time. It examines the risk of investment to analyze the impact of alternative combination of variables on the project's NPV. So what's the difference? Sensitivity analysis calculates the impact of change of single input variable on the outcome of the project. It enables us to identify that single critical variable which can impact the outcome in a huge way and range of outcomes of the project given change in input variable. So we can have different scenarios, different columns in sensitivity analysis: change in sales, change in variable cost, change in discount rate, change in outflow, cash outflow, initial investment, right? So individually we can look into it. However, in scenario analysis, it is based on a scenario wherein all input variables change, right? If it's a recession, demand decrease, selling price decrease, cost reduction, right? All those points put together, one scenario. That is scenario analysis. Calculates the outcome of the project considering the scenario where variables have changed simultaneously. Then variability of the outcome under three different scenarios. Different scenarios can be considered. But scenario analysis is far more complex when compared to sensitivity analysis, obviously, because we are changing multiple variables simultaneously. Okay, this is sensitivity analysis and scenario analysis. With that, we have come to the end of chapter 2. Any doubts in this?
No, sir.
No, sir.
No, we look into some questions then.
Yes,
Yes,
sir.
sir.
Yes.
sir.
First, we look into our RTP. 2023 RTP. Where is this? Page number. Anyone can help me with the page number? I think I missed it.
248.
Yes, I got it. Right. So November 23 RTP. This is talking about RADR. See, look at the question. Simple question. An enterprise is investing 2 lakh rupees, 200 lakh rupees in a project. Risk-free rate is 7%. Risk premium is 7%. Life of the project is 5 years. Following are the cash inflows estimated: 50, 120, 150, 160, 130. Calculate NPV of the project based on risk-free rate and also based on RADR. So one is NPV using 7% discount rate. One is NPV using RADR, which is 7 plus 7, 14%. Straightforward. Right. So such questions also can be asked. Next one, May 23 exam. Here they are talking about scenario analysis. See, a company wants to invest in a project. This requires an initial investment of 4,50,000. Salvage value after estimated useful life of 5 years is 50,000. Other details of the project are as follows. Worst case contribution is 3,30,000. Fixed cost is 75,000. Most likely case and best case scenarios. Tax rate is 40%. Expected cost of capital 12%. Ignore tax on capital gain. Calculate NPV in each scenario. So under each scenario, you have to calculate NPV. Contribution minus fixed cost, you will get the total cost. The profit. Correct? Contribution minus fixed cost. Then have they given us depreciation? Initial investment of 4.5 lakh, salvage value of 50,000, useful life of 5 years. You can calculate depreciation. Then tax rate. That will give you profit after tax. Add back depreciation will give us cash inflow after tax. So that you will discount it at 12%. Under all the three cases, you will get NPV. After that, what are they telling? Company is certain about most likely result in first 2 years. First 2 years, they are getting this result. But uncertain amount remaining period. Uncertain amount remaining period. That means worst case in the remaining periods. In such a situation, calculate NPV, expecting worst case scenario next 2 years and best case scenario in the remaining period. Okay. So first 2 years, most likely. Next 2 years, worst case. Last year, best case. Considering that, calculate NPV. Can we do this? This is scenario analysis, right? This is scenario analysis. So first you are calculating the NPV under all the three scenarios. Then possible outcome. First worst case scenario, then most likely scenario, then best case scenario. That is what this is that. First 2 years most likely, then worst case, lastly best case scenario. You'll get the NPV. Is that clear? Yes. Next one, RTP of May 23. Here they are talking about sensitivity analysis. Remi Limited is a manufacturer of mobile phones in India. Currently, the company is dependent on the foreign supplier for import of battery. It is considering investment of rupees 55 lakhs in a new machine for manufacturing battery of mobile phones. Expected life of the machine is 5 years and no scrap value. It is expected that 3 lakh units will be produced and sold each year at selling price of 20 rupees per unit. Estimated variable cost and annual fixed cost will be rupees 12 per unit and rupees 6 lakh respectively. Consider 14% to be an appropriate cost of capital. Ignore taxation and depreciation. Calculate expected NPV. You are also required to measure sensitivity of the project's NPV to a 10% decrease in project variables sale price unit and sales volume and 10% increase in fixed cost. So first original scenario, we will be calculating NPV. 3 lakh units, sale price, variable cost, contribution. So contribution less fixed cost. Project cash flow. Present value annuity factor, you will get the present value of cash flow minus investment NPV. Then what are they telling us? Sale price reduced by 10%. Sale price was 20 rupees, 10% reduced means 18 rupees. Thereby contribution 6 rupees. Accordingly, everything changes. NPV becomes negative. So 13 lakhs, it became from 6 lakh, change of 303%. That means 30 times it changed because of 10 times or 10% decrease in selling price. Same way, 10% decrease in sales volume. 3 lakh reduced to 2,70,000. But selling price remains the same because we are changing one variable at a time. Selling price remains the same. So using this, your NPV will be 1,45,000. 1,44,000 divided by 6,79,000, decrease in 1 lakh, 121.25%. Same way, fixed cost increased by 10%. All these remain the same. Instead of 6 lakh, 6,60,000 fixed cost. Increase by 10%. Then 4,73,000. So decrease from 4,73,000 from 659 to 473, 30% decrease or 3 times sensitivity analysis. 3 times the NPV reduced. So which is the highest sale price? So sale price will be considered as the most critical factor because it reduced by 303% or 30 times. When compared to the other two variables, this is more critical, is the most sensitive variable of all. Are we understanding?
Yes, sir.
Yes. So that's how we approach sensitivity analysis question. See, December 21 question paper, distinguish between scenario analysis and sensitivity analysis. So that theory question has been asked. Same examination. Adjustment of risk is required for capital budgeting decision. Why? Reasons. Reasons for adjustment of risk, opportunity cost involved, to identify the real cash inflows, right? Those points we have to write. We have one more question. We look into one more question. TIP Limited is considering 2 mutually exclusive projects, M and N. You have been given below net cash flow probability distribution. Net cash flow probability. They're asking us to calculate expected net cash flow. How to calculate? 62,500 into 0.3, 75,000 into 0.3, 87,500 into 0.4 total. For both project M and project N. Then variance of each project. We discuss the format. Variance. Cash flow minus expected cash flow, the whole square into probability. Individually. Then total. That gives you the variance. Square root of that, standard deviation. Standard deviation by expected cash flow into 100, coefficient of variation. Which coefficient of variation is less? That is the project that you recommend. Straightforward. It's very simple, but we should know how to solve. If you know how to solve, full marks we can get. Right? Expected, and it's very simple. See, cash flow into probability. Expected cash flow. Then variance, 62,500 minus 76,250 whole square into 0.3. 75,000 minus 76,250 whole square into 0.3. 87,500 minus 76,250 whole square into 0.4. Add up 10 crore 78 lakh 12,500 is the variance. Square root of that, standard deviation. Standard deviation 10,383 divided by 76,250 expected cash flow into 100, you get coefficient of variation. So here coefficient of variation 13.6 to 15, which is less 13.62. Therefore, project M is better than project N. Is that clear?
Yes, sir.
Yes. With that, chapter 2 is completed. Any doubts in that?
No,
No.
sir.
Oh, okay, fine then. Shall we look into the last chapter?
Yes, sir.
Yes.
Yes. The last one is a small chapter, dividend decisions. We have to just learn formulas. We have to remember certain formulas that is there, right? So here, dividend decisions, whenever I get profit after tax, any company has two options: either declare it as dividend or retain in the business, or combination of them. Correct? Yes. So dividend policy of a company is governed by two things: long-term financing decisions and wealth maximization decision. Long-term financing decision means whether company has opportunities in hand to invest that amount and get a return which is greater than cost of capital. That is shareholders' expectation. What is wealth maximization decision? Wealth maximization decision is regarding the amount of dividend that we have to pay. Quantum, amount of dividend. There is one concept called growth here. What is growth? G is equal to B into R. Retention ratio into what is R? Rate of
Rate of return.
Rate of return. Yes. Retention ratio into rate of return. That's growth. G. Very important. G is equal to B into R. Now, what are the determinants of dividend decisions? Which are the factors that will influence the dividend decisions? Can be asked. Availability of funds. If funds is not available, no dividend. Cost of capital. Capital structure. Stock price. Investment opportunities in hand. If we have investment opportunity, we'll not pay dividend. We'll utilize that money for such investments. IRR, internal rate of return, trend of the industry. If the competitor is paying dividend, then we are bound, we are forced to pay dividend in the trend of the industry. Expectation of the shareholders. Then legal constraint, section 123 gives you the limits in case of loss-making company, etc. Correct? Then taxation impact. There is a change in the taxation now. Last 2-3 years. From exemption, it has gone back to taxable, dividend being taxable. Correct? Yes. Practical consideration. Formulation of dividend policy depends on two things: whether there should be a stable pattern of dividend over the years. If that is the case, then there will be a fixed, like 20%, 30%, whatever, fixed pattern. Or whether you should take dividend decisions separately each year. That depends on the company. Right? What the company wants, what the shareholders want, whether they want based on the profitability of that year or whether they want a stable pattern of dividend over the years. If they want stable pattern over the years, then that is the scenario where dividend equalization reserve will be created. Yes, with regard to theories of dividend, one is relevance theory, irrelevance theory. In relevance theory means the relevance theory, Walter's model, Gordon's model, they say dividend will have an impact on the market price. But Modigliani Miller says no, dividend will not have an impact on the market price. Walter's model, assumptions can be asked in the exam. Sometimes in one of the exams they had asked assumptions. All investment proposals are financed through retained earnings only. That means they are not raising finance, debt or equity. Right? Then R and KE, return on investment and shareholders' expectations, both are constant. It's a perfect capital market. No tax or no tax discrimination, no transaction cost. Firm has perpetual life. These are the assumptions made. What is the formula to calculate share price? Share price P is equal to D plus R divided by KE into E minus D whole divided by K. This is the formula for Walter's model, where D is DPS, R is rate of return, shareholders expectation, E is EPS. Since weightage is given to E minus D, what is E minus D? Retained earnings. EPS minus DPS is retained earnings. Weightage is given to retained earnings. If R is greater than KE, whether you go with retained earnings or payment of dividend?
Retained earnings.
Retained earnings. So in this case, optimum dividend payout ratio is 0%. Correct? Whereas if R is less than KE, what is the optimum dividend payout ratio?
100%.
100%.
100%. Whereas if R is equal to KE, any ratio. any ratio can be optimum, right? This holds good for Gordon's model as well. Both Walter and Gordon. Yes. This model shows how dividend can be used to maximize shareholders' wealth. Retentions influence stock prices only through their effect on further dividend. Emphasizes on two factors which influence market price. One is DPS, one is relationship between return on income and KE. If R is greater than KE, then MPS is more, even if dividend is less, and vice versa. So this is that chart that we discuss now, right? R is greater than KE 0, R is equal to KE any ratio, R is less than KE 100%. Very important discussion. What's the advantage? The advantage is it's simple to understand, it's easy to calculate. It envisages different possible MPS in different situations. So depending on your DPS, different market price can be computed easily. Showcase, right? It envisages different market prices. Whereas disadvantage, it will not consider all the factors. It's only considering your return on investment, your cost of capital, your dividend. That's all. It is not considering other factors, because there are other factors. There are various factors we have discussed. Various factors, but it's only considering those three factors. So it does not consider all the factors affecting dividend policy and share price. It ignores factors such as taxation, legal obligation, etc. And how do you determine shareholders' expectation? Determination of shareholders' expectation is difficult. KE is difficult. Then in Gordon's model, again assumption, firm is an all equity firm, no debt. IRR remains constant, KE remains constant, retention ratio B will remain constant. Growth rate G is equal to B into R is also constant. As B and R both are constant, G will also be constant. And shareholders' expectation is greater than G. That is what they consider. Why? Because in the formula, denominator we have KE minus G. So KE should always be greater than G. Then all investment proposals are financed through retained earnings, no debt. Okay. The formula for market price P0 is equal to E into 1 minus B divided by KE minus G or BR. KE minus G, G is B into R, correct? Yes. So 1 minus B, B is retention ratio. 1 minus B is dividend payout ratio. E into dividend payout ratio is nothing but dividend, DPS. So whatever is there in the numerator is nothing but DPS, D. KE minus BR is G. Okay, that is Gordon's model. Are we understanding?
Yes, sir.
Yes, sir.
Yes, sir.
Okay. So whatever the analysis that we had, it's the same as Walter's model. This Gordon's model is also called as dividend growth model. Very important. It's also called as dividend growth model. What are the advantages? It relates present stock price to present value of future cash flows. We are discounting. At the end of the day, divided by KE minus G means we are discounting. It's easy to understand. Disadvantage, growth rate, capitalization rate are all projections. Right? Are all projections. So accuracy will be an issue. Then true intrinsic value of the stock is difficult to determine. It's difficult to determine the true market value because it's based on projections, estimation. Then we have Modigliani and Miller approach, M&M. So in this case, they are telling dividend policy will not have any impact on the market price. What are the assumptions? It's a perfect capital market. Assumptions normally will be the same. No tax or no tax discrimination, fixed investment policy, no transaction cost, risk of uncertainty does not exist. That's one extra point here. In this case, we will calculate market price. P0 is equal to P1 plus D1 divided by 1 plus KE. Again, we are calculating what? Present value. Simple. P0 is equal to P1 plus D1 divided by 1 plus KE. However, this is for per share. If you want value of the firm, in that case, N into P0 is equal to P1 into N plus delta N, additional shares. Correct? N plus delta N minus investment plus E earnings divided by 1 plus KE. That remains the same. Right? So instead of D1, we go with minus I plus E. Whatever earnings minus investment. P1 into N plus delta N divided by 1 plus KE. How do you calculate delta N? That is the number of shares to be raised, funds required divided by price per share. That's the additional shares to be raised. How do you calculate funds required? I, investment, minus whatever retained earnings. That is earnings minus dividend. N into D1. Earnings minus dividend. That is the retained earnings. Investment required minus retained earnings available is the fund required. Whole divided by P. Price per share. That is how additional funds required, or the number of shares to be raised, additional number of shares to be raised is computed, right? These two very important formulas. Modigliani and Miller. What's the advantage? It's logically consistent and provides a satisfactory framework on the dividend policy. Then what is the limitation? The validity of various assumptions is questionable. These assumptions, certain validities of certain assumptions are questionable. And since one of the assumption is risk of uncertainty does not exist, in case of uncertainty, it might not be valid. That's the disadvantages of Modigliani and Miller. Apart from that, we have two more traditional methods. One is Graham and Dodd model. Second one is Linter's model. In Graham and Dodd, they go with a multiplier, right? Giving more emphasis on dividend. So market price is M into D plus E by 3. Earnings, they are dividing by 3. But dividend, they are giving full weightage. So M is a multiplier. D plus E by 3 into M is the price. Graham and Dodd model. Is that clear? Yes. Market prices, the stock market places more weightage on dividends than on retained earnings. Whereas in Linter's model, we have two things. We have a target payout ratio and the speed at which we want to reach that ratio. Speed at which we want to reach that ratio. That is called adjustment factor. Okay. So the assumptions that they have is firm have a target payout ratio. Management is more concerned with change in dividend than absolute amount of dividend. Change in the dividend payout ratio that they are focused on. Dividend changes follow changes in long run sustainable earnings. So here, dividend of the current year is based on last year dividend plus some increase. Now, current year dividend will be last year dividend plus current year, what is your earnings per share into target ratio. So this should be your DPS. But we will not achieve this DPS today. We will achieve it over years. So this should be your DPS minus D0. That gives you the increment that you want to achieve into the adjustment factor. What is that you want to achieve this year? What is the increase that you want to achieve this year? That is the incremental dividend added to D0 will give us D1. So to D0, we will add this year's target increment. What is this year's target increment? Total ideal DPS. What is the ideal DPS? EPS into target ratio. Minus whatever you are giving already, D0. That is the ideal increase that you want. But you need not increase it in the first year itself. So you will multiply it with adjustment factor that gives the increase that we have to achieve this year. That we have to achieve this year. Right? So what is the disadvantage? It does not offer a market price for share. Here we are getting the dividend amount, not the price. In all other formulas, we were getting market price. Here we are getting dividend amount, D1. And how do you determine this adjustment factor? It's arbitrary manner. There is no standard set given. So these are the two limitations of Linter's model. Okay, these are the concepts. So we had first we discussed about Walter's model, Gordon's model, Modigliani and Miller approach, then Graham and Dodd, lastly Linter's. In Walter's model, what was the focus on? Focus on retained earnings. D plus R by KE into E minus D divided by KE. Whereas in case of Gordon's model, what was the focus on?
EPS.
DPS. E into 1 minus BR. E into 1 minus B that we were focusing on. DP ratio into EPS, which is nothing but DPS. Whole divided by KE minus D. Capitalization. Then Modigliani Miller, we were focusing on what? In Modigliani and Miller's. Current year market price will be, so current year market price will be P1 plus D1 divided by 1 plus KE. That is calculating the present value. To get the firm value also same approach. However, in case of Graham and Dodd model, emphasis is on
DPS.
dividend, correct, DPS. So D plus E by 3 into M. Whereas in Linter's approach, we are focusing on target dividend, achieving it over a period of time. So adjustment factor comes into picture. Okay, these are the things, concepts that are there in dividend decisions. Any doubts in this? No. Okay, we'll look into some questions. This is our RTP. HM Limited is listed on Bombay Stock Exchange, which is currently being evaluated by Mr. A on certain parameters. Mr. A collated following information. The company generally gives a quarterly interim dividend. Rupees 2.5 per share is the last dividend declared. Company's sales are growing by 20% on a 5-year compounded annual growth rate (CAGR) basis. However, the company expects following retention amounts against probabilities mentioned as contention is dependent upon cash requirement of the company. Rate of return is 10% generated by the company. So situation A, retention ratio 50%, probability is 30. 60% retention ratio, probability is 40%. 50% retention ratio, probability is 30%. Situation C. Current risk-free rate is 3.75% with a beta of 1.2. Company is having a risk premium of 4.25%. You are required to help Mr. A in calculating the current market price using Gordon's model. So current market price. So calculation of retention ratio. First in Gordon's model, you want B, right? Retention ratio. So 30 into 50%, 40 into 60%, 30 into 50%. Retention ratio, expected retention ratio is 54%, 0.54. Sorry, 0.54 retention ratio into 0.1 is the rate of return. Growth rate is 5.4%. Apply the formula, we'll get the what? Market price. We'll get the market price under Gordon's model, right? What is the shareholders' expectation? KE will be risk-free rate of return plus beta into risk premium. In RADR, it was just RF plus RP, but KE will be RF plus beta into RP. Very important. They have given beta as 1.2, RP given, RF given. Therefore, shareholders' expectation is 8.85%. Is that clear?
Yes, sir.
Yes. This was this year's RTP. Then May 23 exam. See, following information given: EPS given, PE ratio given. From PE ratio, can we calculate anything?
K.
Yes. What is KE? 1 by PE ratio. Correct. Right. Then rate of return R is given. Market price under Walter's model is given. You have to calculate dividend payout ratio. So apply Walter's model. D. If you get D divided by E into 100 is dividend payout ratio. DPS by EPS into 100. Dividend payout ratio. Correct. Market price of the share at optimum dividend payout ratio. So at what is 12? 1 divided by 12.5 is 0.88%. So rate of return is 12%. KE is 8%. What is optimum dividend payout ratio?
0.
0. So at 0, what would be the market price? We have to calculate. Then PE ratio at which dividend policy will have no effect on the market price. That means R is equal to KE. That means share R is 8%. At that rate, what would be the PE ratio? Sorry, R is 12%, right? 12% is R. So at KE 12%, what would be the PE ratio? 1 divided by 12 would be the PE ratio, correct? Market price of share at this PE ratio. What would be the market price at that rate? Then market price of the share using dividend growth model. What is dividend growth model?
Gordon's model.
Gordon's model. Yes. So that's how it was asked in May 23. Okay. Then we have May 23 RTP. Rambo Limited has 1 lakh equity shares outstanding in the year 2022. Current market price of the share is 100 rupees. Company is planning to pay a dividend of 10 rupees per share. Required rate of return is 15%. Based on Modigliani-Miller approach, calculate the market price of the share of the company when recommended dividend is declared, not declared. Ultimately, you should get the same answer because this is dividend irrelevance theory. Correct? Yes. How many new shares are to be issued by the company at the end of the year on the assumption that net income is 40 lakh, investment budget is 50 lakh. So I minus E minus N into D1. That's what we have the formula, right? When dividend is declared or dividend is not declared. Both scenarios, you have to calculate the number of shares. How do you get P? You will calculate market price. Proof that market value of the company at the end of the accounting year will remain the same whether dividends are distributed or not distributed. Anyhow, once you calculate market price, you will get that proof. Okay. So this is when dividend is not declared. 0. So P1 will be 100 is equal to P1 by 1.015, 115 rupees. Calculation of funds required 40 lakh, dividend distributed nil, funds available 40. So 50 minus 40, 10 lakh should be raised. 10 lakh by 115 is the number of shares that you will raise. Correct? Calculation of value of the firm would be 1 crore in that case by applying that formula. Value of the firm when dividends are paid, P1 plus D1 divided by 1 plus KE, P1 plus 10 by 1 plus KE, you will get P1 as 105. In that case, 30 lakhs will be available for investment because dividend of 10 lakh is paid. 50 lakh minus 30 lakh, 20 lakh to be raised. 20 lakh by 105 is the number of shares. By applying that formula, your value of the firm will remain 1 crore. Therefore, value of the firm remain the same in either cases. Is that clear?
Yes, sir.
Yes. Next, we have one more question. See, explain the determinants of dividend decisions, that factors, right? Factors affecting dividend decisions that have to be written. Then you have one more question. Explain the assumptions of Walter's model theory. So these were the two theory questions asked. This was May 22, which was asked that dividend determinants of dividend was one of the MTP questions. Okay, that's it. This is about dividend decisions. So with this, we have learned the concepts of all the 3 chapters, discuss few questions on it. What we have to do, we have to solve more questions, practice more questions. Compulsorily all the questions of this revision material without fail. Is that clear?
Yes,
Yes,
sir. Yes, sir.
So
Yes, sir.
we will be reasonably prepared with these 3 chapters. Okay. Any doubts on any of whatever we have discussed? No. Okay, fine then. So with that, can we conclude?
Yes, sir.
Yes, sir.
Right.
Yes, sir.
Okay, fine. Okay, so prepare to the best possible extent because these 3 chapters we can score maximum. We can score the maximum. So prepare the best. Solve as much as questions as possible in the allocated time, whatever allocation that you have done. Right. So based on that, solve maximum questions possible. With that, I think you'll be so it will be sufficient for you to approach the exams. Is that clear?
Yes, sir.
Yes,
Yes,
sir.
sir.
Yes, sir.
Yes. Okay, fine then. Thank you.
Thank you,
Thank you,
sir.
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 See you later, sir.
Thank you.
Thank you, sir.
Thank you.